Well, good morning. Ooh. Good morning. Welcome to the South Carolina Department of Insurance. My name is Ray Farmer. I'm the director here. Today is Wednesday, February the 5th, 2020, and we're here today to have a public hearing on a pending rate filing by Genworth Life Insurance Company. Here at the Department of Insurance, we exist for several reasons, but the chief reason we exist is for the protection of our consumers. We do that several ways. One is hearing on rates like we're doing this morning to make sure that the rates charged our consumers are fair and adequate, and that our consumers get the best value for the price that they're paying. Another way we protect our consumers is we have an entire unit that listens to consumers' concerns and complaints and questions day in and day out. We do that, and we do that well. So our reason to be here this morning is to look at the rate filing, and sometimes we have to be aware of what companies request. Our third reason to be here is to make sure that there are companies doing business in this state. We have a good environment for insurance companies. Our consumers are better off when there is competition, when there are companies in the marketplace. Sometimes that calls for a rate adjustment. Sometimes those rate adjustments are painful. So we're here this morning to look at all of that. But one of the biggest concerns that I have here at the Department of Insurance in the insurance sector is long-term care insurance. We all know the issues. It's a product that's been around for 30 years. Companies missed some of their actuarial assumptions. They missed on the lapse rate, the rate that they thought we would either had the length of time we would keep the policy or not. Generally, that's several percent. I understand in long-term care insurance is less than 0.5%. We bought that coverage, we kept it. We need it for a reason. By far, the issue that I talk with consumers about is long-term care rates. I'm a consumer of that product as well. It's a good product. It's a product that helps you protect your assets. I understand the concerns of our consumers. I enjoy talking to our consumers, and so we set aside as much time as necessary for me to talk to any individual consumer on this subject. Our consumers are concerned that they're getting priced out of the marketplace. Most consumers of this product, when they need it, they're retired. They're on a fixed income. And for them to have a jolt of a big rate increase is sometimes catastrophic. So we need to be sensitive to that. And so in order to raise the public visibility of this issue, I held our first public hearing in July of 2018. It was not on any one particular company. We had 4 or 5 companies in, and a number of consumers that we had talked to in the past. We had probably a 2-hour hearing. The video of that is still on our website. It's been seen by over 200 people, but that was a chance for companies and consumers to come in and chat about the subject. Since that time, I've asked the legislature to help us and update our statutes on long-term care insurance. Our process in a rate filing has been a company makes a filing, we make a decision. If the company takes exception to that decision, they have an option of appealing the decision to our administrative law court. That process is the company comes in and makes their case for their filing. The department comes in and gives the information that we have. You'll notice nowhere in that process was a consumer consulted or heard from. So I asked the legislature in 2019 to grant the Department of Insurance the authority to hold rate hearings. This is, as a result, this hearing is a result of that request and that authority. This is our second one of these hearings. We held one a month or two ago, and we're going to have another large one tomorrow. I think it's critical to hold this particular hearing on this company. Obviously, they have a large rate increase pending, but Genworth has about 25% of the market in this state. Probably 10 years ago, we had 100 companies writing long-term care insurance. Today, there's less than 10, and I'm not so sure there's more than 7. Genworth is one of those companies that continues to write long-term care insurance. So today we'll be discussing 6 blocks of closed business that Genworth has written. 5 were issued to individuals between 1994 and 2011, and then 1 block was issued to GE employees in South Carolina between 1992 and 2012. So our process internally is when a company makes a rate filing, our assistant actuary takes a look at it, makes her determinations, then she shares that with our in-house actuary. And then to make sure that we're dotting all the I's, crossing all the T's, as we did in this instance, we'll contract out with an external actuary. In this case, it's Lewis and Ellis, represented by Dave Dillon. In a few minutes, he will share what he and his team has found out or looked at in this filing. So kind of the order that we're going to go in this morning is we'll hear from Dave Dillon, and then we have a number of consumers that have registered to speak. I am delighted that they are here. Some could not make it, but some have sent us letters. So we will have 2 people read those letters and kind of keep things flowing. We'll hear a live testimony, then we'll read a letter, and we'll bounce back and forth in that respect. And like I said earlier, one of the reasons the Department of Insurance exists is to protect our consumers. We are the consumer advocate for insurance issues in this state. But we do also have the luxury of a consumer advocate that looks at not only insurance, but all other types of consumer issues and products. So I've asked them for another perspective, them to attend. And Becky Dover is here and will participate when the appropriate time comes, when she can ask questions and so forth. I will ask questions of Dave Dillon. I'll ask questions of the company when they speak. And so I'm sure consumers are going to have questions. Let's see if I ask those questions first, and then you'll be permitted to ask probably the company is the ones you want to direct the questions to. And we'll hear from Genworth after. We also, I think we'll have representatives from the AARP here this morning, and we'll hear from them as well. And then we'll hear from Genworth. So as you'll see, this is going to be a full morning at least. I will certainly be aware of the time to take a break. And I'll lead that effort, trust me. Just so everyone knows, we have a court reporter taking down every word that's said here, and we also have this, it will be videoed. It is not live stream. We don't have that capability yet, but the video will be posted on our website probably within a week. So I would encourage you, if you need reference back to that, to look at that. So it is past time to get started, so we'll hear from Dave. Dave Dillon from Lewis and Ellis.
So for those that don't know me, I'm Dave Dillon, Senior Vice President and Principal of Lewis and Ellis. My main job as a consulting actuary is to assist states. I currently assist 14 states with actuarial work. That's either on the rate review side or on the solvency examination side. So my staff has a lot of experience reviewing rate filings. In the last 10 years, Lewis and Ellis has assisted 22 states in the aggregate, different types of filings, including long-term care. Right now, we are assisting in long-term care Hawaii, Kentucky, and South Carolina with long-term care reviews. So my staff is well-versed in long-term care. And here is a quick overview of the rate increase request. Now, I've had the pleasure of trying to take thousands of pages of documents and summarize them into about 10 pages. So obviously this is very simplistic and it's kind of small to try to shove everything in here, but you may have access to these slides. But basically, as you can tell, there are some pretty big increases here. And there are some ranges here. Now, one thing Director Farmer mentioned, and unfortunately, he was correct, is when these products were originally priced, the industry got it wrong, okay? So we're not really arguing. I don't think any state would argue that rate increases aren't necessarily needed. But what we are reviewing is to make sure that the rate increase requests are appropriate, actuarially justified. I don't think any state is just going to, well, I guess maybe I won't say any state, but I don't think most states are just going to reject the rate increases if they're appropriate or not. But that's why we're asked to help. So let's go into a little bit on what is the process of the review. As Director Farmer mentioned, what we do here is a little bit different in that it is a partnership with the staff here. So the South Carolina Department of Insurance staff kind of start the review. They review everything and then they send it to us, and then we kind of do a separate review. And then after we have done a review, we coordinate with the department on the questions that we think should be asked and the objection questions and things. The process that Lewis and Ellis uses is what we typically do. We usually have more than one rate filing at a time here at South Carolina. So we'll have one credentialed actuary be the lead. So for example, for Genworth, we had a lead credentialed actuary, and then we have another credentialed actuary that's a lead for another filing, kind of be a peer reviewer. And then I'm kind of the secondary peer reviewer. And so I review the filings to make sure that my main reviewers have hit all the issues, have hit all the hit the issues that are market-wide issues. They may only work in South Carolina or Kentucky, and so I make sure that they're consistent with what we have seen nationwide as well. But there are two kind of main standards as actuaries that we have when we review a rate filing, and that's really the actuarial standards of practice and state law. Okay. Now, the actuarial standards of practice are kind of the personal, standards that we have to abide by. But the actuarial standards also are very clear in saying that if state law says something different, state law overrides, right? So it's kind of a dual thing, but as you'll see in our outline here, in South Carolina, a lot of it does line up, and there's not a whole lot of differences, but the South Carolina does have some different nuances in the state law. But and I've only pulled out a few of the issues here in the actuarial standards of practice number 8. That's the one that's regarding rate filings. And there's really two main sections of that are very important. And that is the regulatory benchmark and the reasonableness of assumptions. And so that's where we kind of talk about and make sure that the rates are adequate, they're not excessive, they're not unfairly discriminatory. So unfairly discriminatory, adequate and excessive kind of makes sense to someone that's not an actuary. Unfairly discriminatory is a little more squishy, but what that gets at is basically that the premiums charged for two different people makes sense versus like the claims that those two people would have. So if maybe they're 10% difference, this person should have 10% more claims, the premium should be about 10% more, okay? And we look at the projected loss ratio. And then, of course, the reasonableness of assumptions. I've pulled out one of the phrases, the assumption should be reasonable in the aggregate and for each assumption individually. Okay, that's a very important consideration. Then we'll go into the South Carolina law, and again, as you can tell, this is very similar here. We've got, Director Farmer has 6 criteria. He can disapprove or modify the premium rates, and 4 of those are related to the regulatory benchmark that I mentioned, the inadequacy, the excessiveness, unfairly discriminatory, those issues that I mentioned earlier, and then 2 are related to the reasonableness of the assumptions that I just mentioned regarding if they're reasonable in the aggregate or individually. And then Director Farmer has another 6 factors, and this is where the state law is a little bit different than the actuarial standards of practice. Director Farmer can take into these 6 factors into consideration: past and prospective loss in and outside the state, underwriting practice and judgment, a reasonable margin for reserve needs, past and prospective expenses, prior approved rate changes, and any other relevant factors. Okay? Not every state has that. Director Farmer can take into consideration any other relevant factors. Okay, so now I'm going to get into some of the individual filing observations, and as I said, this is a highly condensed summary of our review. And I would also say, well, we are not at the position that we've made any formal recommendation to Director Farmer yet. And I should also say that these observations, they shouldn't necessarily, one is not necessarily more important than the other one, but these are all considerations for Director Farmer in his evaluation of these filings. There may be one that, as I said, he's got those 12 factors. There may be a couple that are higher priority. So I've just kind of listed some of these issue here. So some of these, I think one thing that is a consideration is many of the proposed rates on these rate increases are higher than similar policies currently being sold. So that is one of the considerations. Director Farmer mentioned that there aren't many carriers that are selling policies right now. Most companies have closed all their books of business. Now, there are considerations why a closed block and an open block, why there would be some differences, different populations and so forth. But however, if new business rates are significantly lower than the proposed rate increase on a closed block, that tells you something about possibly the inadequacy of the new block or the excessiveness of the rate increase on the closed block. South Carolina policyholders are paying higher than the nationwide average right now. The most recent approved rate increase was in 2017, about 20%. One of the key observations throughout all of these, and this slide is primarily, it's kind of the individual filings. As Director Farmer mentioned, there's 6 blocks within this filing, 5 individual and 1 group, and this is kind of a summary across all of the individuals. I'll have a summary, separate summary for each of the blocks. But one of the key considerations here goes back to when I said earlier about checking the assumptions individually, and this goes to the discount interest rate. The company has used is using an interest rate in their projections that is much lower than what they have earned over the years, and that makes the rate increase higher than what it otherwise would be, and it makes the losses look worse than it otherwise would be if they had used actual investment rates that they had used throughout the years. So now just some quick bullet points. Each of these, I won't necessarily hit each of these. Each of these blocks have some different nuances from the other. There's some similarities, but there are some differences too. But I think you will sense a theme. Here's what the 53% increase, but the company has said that it does plan to have more. If this rate increase is approved as proposed, the rates would be about 3 times the original rates. This is for the pre-PCS filing. And then for some policyholders with limited benefit periods, some are projected to produce reasonably favorable results. This goes back to that comment I was talking about earlier, the unfairly discriminatory. You know, there's different blocks, sub-blocks of business within each of these rate filings, and there were some cells within this filing where some of the blocks have much lower loss ratio, or that means more favorable results for the company than others, okay? So very similar story here. Large rate increase, but it's only a portion of what the company has planned to ask for. For this PCS filing, the rates would be approximately 4 times the original rates. The PCS2, again, as I said, there's some similarities here, about a 37% increase, but only a portion of the large increase the company plans to implement. There's been a cumulative rate increase on this block of about 172%. The rate increase would be about, the total rates would be 3.75 times the original rates. This is the first block, and there's a couple of them where the company has introduced a stable premium option, which, you know, a lot of, in lieu of large rate increases, a lot of companies are offering alternatives. And this Genworth's option basically would be to accept a rate increase as well as reduce benefits to protect from future rate increases. The choice one, again, a 36% increase is a portion of the large rate increase. Very similar, you know, rates have been increased significantly since originally introduced. And again, this one has the stable premium option. Okay, choice two is a little bit different filing than the other one. Depending on when a company files or has introduced long-term care, there's kind of different rules, and this one's a little bit different. But this one, the company has proposed a 21.4% increase. Again, this is one with the stable premium option. The interesting thing to note here is the company is not expecting other future rate increases, but they're introducing the stable premium option, which would reduce benefits also, which was a little curious to us that they would have a reduction in benefits if there weren't any future increases expected. To date, not counting the proposed rate increase, there's been a cumulative rate increase of approximately 62%. Okay, so the company originally projected for choice two to spend about 68% of premium on claims. The best estimate projections come true, they would spend less than that as of right now, is what the projections are saying. And then the company is arguing that they're experiencing adverse conditions because claims are way higher. The interesting thing here is the company, from our view, is ignoring that they're actually receiving more money to cover that adverse experience. So yes, their claims have been worse, but that does not appear to trigger adverse conditions because they are ignoring the extra revenue and extra surplus in addition to those amounts. Here's the group filing. Again, very similar story to some of the others, 2.5 times the original rates. An interesting thing to note here is the company assumed a 3.5% interest rate, and I've talked about the interest rate a couple times. The interesting thing here is it's different than what they assumed in the individual filing. One thing to note is that a company, especially like Genworth, that is primarily just a long-term care company doesn't segregate their assets based on their product. So it looks a little inconsistent that they would in one filing say 4% is consistent, it is best estimate, but then they use 3.5% in another filing, which would make the losses look worse in this group filing as compared to the individual filing. And that is it for the formal presentation, Director Farmer.
Okay, Dave, let's, I've got a couple of questions that I want to ask, and then I'll open it up to see if we have a couple from the audience. One area that you focused on was the interest rate, the difference between 3.5% and 4% in the two different blocks. And you also focused on the rates for new business as opposed to old business, or the closed blocks, and the rates in the closed blocks are higher than what they're charging new customers. That's a concern for several different reasons. Which is correct? Do they need it in the old block, and are they charging enough in the new block?
Yeah, that's definitely a concern. I mean, I think it puts stress on the consumers too. I don't know how if the consumers know that, but they should go look at the new policies. They'd get a better rate than some with the larger rate increase. But it does speak to if you get rates that don't appear consistent, then it does lead to really reviewing the assumptions underlying those projections.
All right, and back to the interest rate, what was the actual rate of return?
So it does vary by year. There were some years that the company earned about 7.5% in a given year on their assets. And, I'm well aware that, companies do like, and I've done this on filings as well. I mean, you don't necessarily want to go back. Some of these policies are 30 years. So while it would maybe be onerous to assume 7.5, 7, 6.5, 7, and go back, and you want something relatively, maybe an average or something, but you've got to pick something that is representative of the cash flows earned. The importance of the interest rate is a company really only has two ways to earn money to cover the claims: the premium from the consumer and the investment income. So if in these projections that they are projecting less investment income than they've actually earned in the past, then that's artificially raising the premium they're going to have to charge for the consumer. It's very tricky. We see some companies assume that what we would call the valuation interest rate, which is really more of kind of the accounting standard, but that is designed to be conservative, and that is for accounting standards, not necessarily for pricing, and that artificially bumps up the rate increases. Again, you got to be careful with averages, right? I mean, if you played a game where you either won $3 and $5, an average of 4 is not too bad, right? But what if you had a game where you lost $4 million and you won $4 million and $4 and the average is $4? That's a different game, right? So you got to be very careful with averages. So that's why the investment rate is so important. Is it's really the other side of the coin of how much money a company will get from premiums.
And the investment rate when these policies were sold 30 years ago was tragically different.
Yeah, much different than they are, much higher than they are now.
Okay. I think I saw one question, Mr. Rocker.
Information question.
Yes.
One, can we get a copy of those slides?
Oh, okay, I've got that in my notes to address. As soon as the hearing is over, they'll be posted on our website.
Thank you. The second question is, how deep of data can I get on the block that I'm in? How many people are in it? What is their age? Is that information available that I can do my own calculation?
I think that's probably information we can help you with to do that calculation. I'm thinking that in each block, the company knows basically who's in that block. And so with
Historical trends as to how many there were and how many less there are now and so forth would be relevant.
Yeah, we can certainly talk to the high levels.
Yeah,
Sorry, go ahead.
we'll discuss this.
Thank you.
And we'll make every effort to answer that question. I think all that can be done, but we need to see. Yes, ma'am.
I just have a quick question. Can you go back to the slide? Yeah, there you go. A rate increase of approximately 21% would be necessary for South Carolina rates to meet the nationwide average. Early in your talk, you said South Carolina is paying higher rates than the nationwide average, about 9% higher.
Yeah, depending on the block. There's 6 pieces in here, and so this one is where the a rate increase of 21% would be South Carolina would meet, but in the other blocks, and it varies by product underneath too. There are some benefit periods where South Carolina probably pays a little less than nationwide, But in general, South Carolina has paid more than nationwide.
Okay,
So it's not a blanket statement across every benefit option that the company has offered or product type.
okay, thanks.
Mm-hmm.
That's also the group buying.
Correct.
So that's a whole lot different than these individuals.
Okay. Yes, ma'am.
I just have a question for you, because I'm a long-term care agent and have been since '91. And you made a statement about a consumer looking at a policy today versus the rate increase. I do this all the time with my clients, and I could not buy a policy today at my age, because I do have a policy, at the premium they would want today for the same benefits, because some of those benefits aren't even asked, or offered, I should say. So I disagree that somebody who is 10, 20 years older can buy something today for what the premium.
I want to clarify, I did not say you would get the premium and benefits exactly.
Okay, maybe I misunderstood you.
So there is a relativity. So what we would call actuarially equivalent. So benefits may be less, but the premiums are going to be less to the right amount. So what we look at when we look at the new versus the old products is, yes, the newer products have less benefits. I'm not going to argue with you. I'm a son of an agent. I deal with that too. But what we look at is what we would call the actuarial equivalent. You might get more value from your premium to benefit relativity as compared to just looking at the benefits. You may be paying more, so on an older policy, you may be paying more for dollar of benefits than you are now. But yes, the aggregate benefits could be less.
So in my experience, the policies that are sold today are far different than the policies sold 30 years ago. Genworth sells a pure long-term care policy. Other companies have gone to a combination of maybe a portion for life insurance and a portion for long-term care. So they're kind of all.
Yeah, and that's a good point. About 85% of new sales now are combination products with annuities. Very different market. Yes?
All right,
Final question.
Final question.
There was reference there with respect to the probability that the insurance companies could offer or require benefit decrease along with premium increase. Benefit decrease along with premium increase. In accordance with the contract that I have for my policy, they can't kick me out. Can they put in such egregious combinations of those two factors such as to eliminate the usefulness of the policy?
So I'm not an attorney, so I will answer as best I can, and I'll let Joe or somebody else address some of the issues I don't address. But the way the contracts are from an actuarial standpoint, you're correct. They can't kick you out. But there is not a rule about what they can necessarily charge you for that. They can raise rates, and then that's the department's position, and to review what is the appropriate rate for that. And so what a lot of companies are doing, and this goes into some of the legal stuff that I can't necessarily speak to because it does vary by state and does vary by product, is some of those you can't reduce benefits, but some you can. Or if they ask you and you say, yeah, that's fine, then they could. So instead, it's just a combination of kind of what I was getting at. You could choose, instead of having the large premium increase, you could reduce the benefits.
So we're about to start hearing from, thanks Dave, we're
Yep,
about to
thank
start
you.
hearing from consumers, but let me tell you this before we start. Some of you are gonna have general questions that can be answered, some will have questions that only can be answered to your specific situation and maybe with a company. Our staff is here all day, and so after the hearing, if you have questions that aren't answered or asked and answered, we're still here to answer those questions. I do not want anybody to leave with an unanswered question. We don't like the answer to the question, but the reason we're here is to answer all those questions. So we will start now. Ms. Siegel. I'm going to ask you to try to limit your comments to 5 minutes. You know, I'm not necessarily going to ring a bell,
It's not a problem.
but I do want to hear everything you've got to say.
My name is Janet Siegel. I live in Charleston. And I first want to start by thanking Barbara Franklin and Genworth for peace of mind for me, my partner, my kids, my grandkids, for the last 8 of the 10 years that I have held a policy. However, this peace of mind is eroding. As I said, I'm a Genworth policyholder, and I'm horrified at the possibility of endless premium rate rises. Insurance is most like legalized gambling, in that I gamble my money on a policy that I hope to never use, exactly as I do with my homeowners, my flood insurance, my valuable property insurance, my car insurance. I hope to never need them. But to listen to an international, multi-billion-dollar Fortune 500 company proclaim they didn't realize the long-term costs of long-term health care is almost laughable. How could a reputable company not rely on the facts and evidence of an aging population and ever-increasing medical costs? It's been clear to me the government is never going to subsidize seniors' health care needs. So I took it upon myself to level the playing field and purchased a long-term care policy for my future needs. On their website, Genworth proudly states, quote, "For over 145 years, we have been focused on helping our customers navigate caregiving options, protect and grow their retirement income, and prepare for the financial challenges that come as we age. We are here to be a trusted ally for everybody who needs care as they age, and anybody who loves them." Trusted ally? For whom? How does that translate to me? If Genworth really wanted to help people, they would encourage our elected officials in Washington to negotiate drug costs and to secure and raise the payment for Social Security and Medicare. As some in this Congress wish to destroy Medicare and Social Security, the financial and health care plight of every senior is in jeopardy. I understand that insurance companies are in the business to make money for themselves and their shareholders. I get that. They might say they care about customers, but this instance of raising premiums to outrageous levels shows just the opposite. I made what I thought was a strategic gamble to take care of my future needs without being totally dependent upon Medicare. I have voluntarily paid increasing premiums in an effort to be smart about the future, my future. Genworth entered that bargain with me, their customer, willingly. Now they're crying foul after continuing to cash my checks. That the cohort of baby boomers would all get old at the same time was known when I was born in 1948 and through 1952. No surprises. Now we in that age group are in jeopardy, and it is crucial that someone take a stand for seniors. Again, from the Genworth website, 7 out of 10 people will require long-term care in their lifetime. That's from a 2019 Department of Health and Human Services report. This is important and terribly scary. For those of us who have invested in long-term care policies for many years, the prospect of losing coverage because of inability to pay the escalating premiums is alarming. I appreciate that South Carolina has a 20% cap on premium hikes, but the threat of even 20% is disturbing to the core. If Genworth uses the Department of Health and Human Services statistics as part of their selling talking points, how do they now claim that they didn't see the costs rising? It just doesn't ring true. Were they fibbing on the sales side? Or are they covering up something now? They shouldn't be allowed to have it both ways. Please, Mr. Farmer, help direct the conversation from, quote, How do we keep a multi-billion-dollar company make more profits, end quote, to, quote, how do we ensure quality care for our aging seniors? We made a pact with this company and took the gamble in an effort to ease costs and therefore avoid becoming government burdens in the future. It's not Genworth's customers who should be left holding the bag. Insurance is a valuable tool for businesses and for individuals, but if only one side of the equation is allowed to change the agreement, who benefits? Not the individuals who pay in with good intentions. Thank you for your attention.
Well said, Ms. Siegel, thank you. So as we indicated earlier, we're going to kind of intersperse the live testimony with the letters. So reading the first letter will be Joe Cragen, our assistant to the director.
This first letter is from Miss Susan Ellis, who is from Spartanburg, South Carolina, and could not attend. Dear Mr. Cragen, I am writing to you in regard to the upcoming February 2020 hearing about the rate increase for Genworth that Genworth has requested for South Carolina policyholders of long-term care insurance. My husband and I purchased long-term care policies with Genworth in December of 2007. At that time, I was 56 years old, and my husband was almost 61 years old. We entered into this contract with Genworth in good faith, with the understanding that occasional increases in premium could occur. There was no limit to the time period covered by our initial policies once they would be needed. Although we didn't opt for the, quote, Cadillac, close quote, or top-of-the-line policy, we were comfortable with the policy we chose so that it would cover a certain percentage of costs, with our being able to cover the remainder out of pocket. 7 years later, in 2014, we were notified of a 13% increase to premium to maintain the same level of coverage. We decided to pay the increased amount to keep the terms of the initial coverage. 2 years later, 2016, we were again notified of an increase. This time, we chose to reduce our coverage from unlimited to 96 months, in other words, 8 years, with a maximum payout of $720,000. This change resulted in a decrease in premium of less than $10 a year. Almost 2 years after that, 2018, the third increase was announced with a significant increase in premium. Due to the sizable increase, we again reduced our coverage to 72 months at a maximum lifetime payout of $540,000. Not only did we end up with far less coverage, but our premiums were also higher than ever, a 7% increase from 2016. We purchased these policies in order not to burden our children with our health care costs. The policies also were a factor in our financial planning for retirement years, so that we could be secure that our out-of-pocket expenses for health care would not deplete our savings before our lives were over. Most retirees, including ourselves, have a fixed income, and we have made financial decisions based on our fixed expenses versus our income. We could handle modest increases, but we don't consider these increases to be modest. If Genworth actuarial forecasts were in error, we do not believe that the client should necessarily shoulder the bulk of the burden. If indeed the increased level of cost for long-term health care policyholders has actually risen to this extent, we would be curious to know if independent actuaries agree with the data that Genworth has offered as evidence that Genworth deserves an increase. In addition, the requested increases under consideration in this hearing, according to the chart on the DOI website, are draconian for the policyholder. If approved, this would be the fourth increase made to our policy premium in 8 years. My husband and I are beginning to view these increases as a scheme to drive us to choose a much lower level of coverage, or ultimately to say, forget it altogether and pull out of the policies. From 2007 to 2019, together we have paid $53,264.94 in premiums. It is almost like a, quote, bait and switch, close quote, strategy from the insurance company. If we decide that we cannot continue to pay those increased premiums, then Genworth pockets the $53,294 and has no obligation to us at all. This trend is certainly a good way for the company to show a profit at our expense. Please relay our thoughts to those present at the hearing and convey our regret that we cannot attend in person that day. Sincerely, Susan G. Ellis, Spartanburg, South Carolina.
Thank you. Genworth, have a copy of the letter.
Yes.
Okay, and so we'll provide another copy for the court reporter. Already have, okay, good. Okay, Mr. Alan Bundy.
Thanks for the opportunity of talking with you folks this morning. By separate correspondence, I submitted a letter to Joe, and I would like that letter entered in the record.
Good,
Part of that letter I will cover in this discussion here.
okay.
Back in 2006, my wife and I elected to buy or purchase long-term care insurance, and we explored the industry at the time with a very, very, very capable insurance agent, happened to be my son-in-law. Anyway, back in those days, the company, Genworth, had this brochure. And we were attracted to Genworth by a couple statements in the brochure which read, and this was back based upon a brochure dated in 12/31/04, meeting our needs or our approximately 1 million policyholders is not only our priority, it's our commitment. We have paid out more than $2.3 billion in long-term care claims. We're here for the long term, today, tomorrow, and in the years to come. Pretty impressive statement. It's in the brochure. The other statement that was in the brochure dealt with premium stability. And that particular quote read, "While we reserve the right to raise future premiums for all policyholders by state and class, we have never had to do so on any policy issued by us since we pioneered long-term care insurance 30 years ago." Pretty impressive statement. Those statements, together with the research of the industry, led us to purchase a long-term care policy with Genworth. For a number of years, until 2015, our premiums remained stable and did not increase. From 2006 to 2015, our rates remained steady at $2,301 annually for a long period of time. However, in 2015, our rates increased from $2,301 to $2,596. That was an increase of 13%. In 16, our rates remained steady at the $2,596. But in 2017, our rates increased from $2,596 to $3,115, an increase of 20%. In 2018, our rates again increased from $3,115 to $3,738, an increase of another 20%. Those rates remained steady in 2019 up to the now proposed rate increase of greater than 20%. Based upon those facts, the policy premiums have increased 144% from 2017 to 2019, 144% in that short period of time. By the same token, our policy overall from the time we took it in 2004 to 2019 or now increased 160%. Based upon these facts, this leads one to question the overall confidence of Genworth Insurance Company in forecasting their future rates based upon their advertised professionalism noted in their past literature. In 2018, I was concerned and my wife was concerned. We wrote a letter to you. We were referred to the Genworth Policy Group, and they sent us a very lengthy letter. Mind you, generally filled with a lot of gobbledygook. However, I'd like to emphasize a couple things that it did talk about. There were two key facts in the whole pile of gobbledygook. Their reply to my March 27, 2018 letter stated that policyholders may be able to keep their premium levels about the same regarding the 20% rate increase by choosing one of several changes to their benefit options, including reducing the policy's monthly and or maximum benefits, or increasing the elimination period, or changing the policy's benefit inflation options. When we purchased our policy in 2004, we were not advised of the extent of possible premium increases, and we purchased the policy with options beneficial to our lifestyle and for our kids. We were not advised of the possible adverse changes to retain our premiums about the same over our aging years. The second thing this lengthy letter had of any significance was respect to the company's reasoning for the increased premiums, and stated that the Genworth decisions to increase premiums is primarily based upon the fact that the expected claims over the life of our policy are higher than we originally anticipated when our policy was priced. Therefore, Genworth will be exposed to higher than actuarially anticipated claim costs. Assuming all that to be a true fact, in April 2018, the submission of additional rate increases for 2020 does not appear justified, since Genworth appears to be recouping costs for poor past management decisions by their actuarial forecast group. Genworth should be required, as a minimum, to fully justify the number of claims submitted in South Carolina in past years since 2015 and the associated costs of such claims. The trend of costs should be compared with the trend of requested premium rates for the same period of time. While it is understood that people are living longer today, people are also healthier today than 20 years ago. This trend should have been closely considered by Genworth in the forecasting of rates. The background of past literature for addressing the billions of dollars of claims that I showed you prior to 12/31/2004 was the basis for our purchasing of the policy. The possibility of future rate increases and the magnitude of such increases was never discussed at the time of purchase. The fact that the policy over a short period of time, 2017 and 19, would increase over 140%, and even more based upon the proposed rate increase forthcoming, was not considered by us at the time and is considered to be absolutely unfair and unreasonable. We trust that the current request for rate increase made by Genworth Insurance Company will be significantly limited in value, maybe zero, since in the opinion of this policyholder, the Genworth management has poorly forecasted claims, and the general public should not be held accountable for poor performance of a private company. Now, since I submitted my letter, I had a couple other thoughts, and I'd like to just comment on that. Over this same period of time, the stock prices of Genworth Financial have remained stable, and dividend payments have also remained stable. To an outsider like me and maybe you, it appears that the company is stealing from, we'll say, the poor, that's me, and paying the rich in order to compensate for poor management. When I was in corporate management in America and subject to rulings of the Public Service Commission on hearings such as this, when the rulings were not favorable to the company for which I worked, we, the company, had to find other ways of adjusting our cash flows and our outflows of cash. In closing, let me refer you to a Genworth website, which if you go on it, which states, leading the industry. We helped pioneer long-term care insurance over 40 years ago, and we're still leading the industry today. It does not address, the website does not address the matter of fairness to the policyholder. Thank you.
Thank you, Mr. Budnick. For the record and the court reporter, would you state your full name and where you're from?
I'm Alan Budnick. I live in Aiken, South Carolina. Horse country.
Thank you for coming. Appreciate your remarks. So now we will hear a second letter. And Kendall, was that you? Yeah, Kendall. Kendall Buchanan, our Deputy Consumer and Market Services, will read this letter. And then we'll take a short break.
This letter is addressed to Joe Cragen. Dear Mr. Cragen, thank you for sending us the notice of the Genworth request of a rate increase for long-term care and allowing us to comment on that pending action. Unfortunately, due to prior significant commitments, we will be unable to personally attend the rate hearing on February 5th, but would like to take the opportunity to comment below. Following are our comments, thoughts, and recommendations. 1. Initial long-term care policy date signed December 18, 2003, effective January 26, 2004. 2. A major consideration for us prior to signing the policy involved rate increases. We understood that to some extent occasional rate increases would be necessary, but the following written paragraph in the sales presentation provided in 2003 was discussed and led us to expect a minimal, reasonable increase when required. End quotes. To date, GE insurers have never had to raise premium rates on any of their existing long-term care policyholders, dating back to 1974 when GE's long-term care division pioneered long-term care insurance. However, past performance is not a guarantee of future performance, and therefore our policy's premium rates may increase in the future for reasons including but not limited to the factors described above. And then the note is regarding age or health. 4. Actual rate increases in my policy. In January 2004, the initial premium was $2,154. In January 2016, it increased by 22.5% to $2,916. And there's a note that that's a 22% increase in 12 years. January 2017 to present, the premium increased to $3,500. And that's a 20% increase over the prior premium for a cumulative increase of 62.5% in 13 years. January 2021 estimate, $4,200 in premium as an estimated 20% increase for a cumulative increase of 95% in 17 years. The above figures, while perhaps considered necessary by Genworth, should also be considered extraordinary and somewhat contrary to initial expectations to many policyholders, including us. An estimated potential 20% increase since the last policy increase and a 95% potential increase by 2021 will definitely create a considerable concern and even a probable hardship to many policyholders. We are also sure that there will be alternatives suggested to policyholders which would decrease the annual premium in exchange for reducing the total amount of benefits, reducing the time the benefits will last, delaying the time before benefits begin, or modifying inflation protection. Of course, we also expect that the monthly benefit maximum will also increase as a natural inclusion in the cost increases. Recommendation. 1. We are sure Genworth will have figures demonstrating the revised, in quotes, cost of care expenses for our area, which will demonstrate a need for a rate increase, but will they also have figures showing an, in quotes, impact of a rate increase on quality of life for policyholders, end quotes. I am sure it would be quite interesting and should be included in any decisions. 2. We understand that long-term health care costs will increase, but find it difficult to accept that we, who have been policyholders for many years, will be subject to these considerable premium increases when they were not expected or planned for at this level when contracts were signed. 3. We expect and appreciate that the monthly benefit maximum will also increase as part of any rate increase, but some form of Genworth revenue and expense practices should be revised to, at least to some extent, mitigate the impact to the policyholders, especially long-term policyholders. Perhaps consideration could be given to grandfathering current rates, at least to some extent, and reducing expected increases based on 1, those above a specific age, 2, based on income levels, or 3, based upon the length of time a policy has been in effect. We thank you for the opportunity to provide our thoughts, comments, and recommendations. We would be willing to discuss more fully if requested. With regards, Michael Massey and Petra Massey of Anderson.
And our next consumer is Mr. Sullivan, Terry Sullivan. And if you would, Mr. Sullivan, when you take the podium, repeat your name and where you're from.
All right. Good morning. My name is Kerry Sullivan. I'm from Charleston, South Carolina. I am not a policyholder. My father is, and my mother was. So he couldn't make it today. He's getting some physical therapy after a little surgery, and he's kind of kicking along. So I'm here for him. And he purchased his policy back in 1990, and fortunately he had the foresight to do that, he and my mom. We did have to cash in on the policy. Last year. So anyway, I'm very concerned about the increase, and really you've answered, particularly Dave has answered a lot of questions that I had this morning, so I'm going to kind of skip that part. But one thing I am a little curious of, I am soon to be in the market. I'll be 60 next year, and I'm going to be in the market for insurance. And I'm a little confused. You know, typically insurance, you have little incremental increases as you go along instead of the big ones. So I'm kind of interested. You may address that later, and that's fine. I'm not looking for an answer right now on that. So it's definitely a concern I have as I move forward. And obviously for my dad, who is now 85, and with the rate increases, he's not able to go get another policy. And, you know, we'll continue the policy because he's paid in for so long, and he bought it a good time and has maintained a high level of premiums as opposed to taking the reduced benefits, which I'm very grateful for. So all that really being said is that, you know, I'm really worried about the strategy behind the price increase, whether it's, you know, truly to recoup costs, which y'all are certainly looking into, or is it looking to try to drive people out of a policy that they've paid into for years? So that's really the heart of my concern, is that, you know, we don't leave these people behind that have paid in for years and, you know, can't afford the rate increase. Fortunately, you know, we're in a my dad's in a financial position to be able to afford it. However, that's not what we want to do. So really, that's my biggest concern, is what is the strategy behind it, and really why the incremental pieces aren't there to where you can plan and budget for it every couple years or whatever the increase might be. So that's really the heart of my concerns.
Thank you, Mr. Sullivan. And to address that last portion of your question, that the rate increases now were mostly unexpected. When we purchased the policy back in 20 or 30 years ago, we thought, whether we were told or not, but we thought we would have very little or no rate increases. And so that's the dilemma that everybody in this room now faces, whether you're a policyholder or representative of the company. You know, how do we manage those things? And Mr. Sullivan, at least now you know, when you purchase your long-term care coverage, you need to expect these rate increases in the future. You've been put on notice that we don't know how many rate increases that you would have in the future. So now but I certainly appreciate you making the trip up, and your testimony is well received, and we appreciate it. So Joe, how about reading the next letter?
This letter is from Thomas Ackerman, who's from Anderson, South Carolina, and it's dated January 21st of 2020. I protest Genworth's request for another premium increase. Genworth has increased my premiums almost every year since it acquired the company by merger. After South Carolina Department of Insurance granted Genworth's 2018 request, my quarterly premium increased from $396.67 to $472.01, 19%. My wife, Patricia P. Ackerman's premium has increased significantly also. We have had this same long-term health insurance policy since April 1st, 1995, which is almost 25 years. We originally got our policies through the National Association of Active and Retired Federal Employees, which advertised that the premiums would never increase. After I protested the 2018 increase, Genworth incorrectly drafted my bank account by the wrong amount on May 1st and August 1, 2018, which according to Genworth was due to, quote, inadvertent mistake, close quote, and, quote, isolated administrative system issues, close quote. Genworth's letter of July 13th, 2018 stated that my bank account will be drafted $24.51 on August 1st, 2018, which must have been the all-time low premium for Genworth. I suggest that Genworth consider reducing its budget by 20% to include all expenses, including pay, benefits, perks, etc., of all employees, including the CEO, or pass along part of the profits to policyholders. Sincerely, Thomas M. Ackerman. And then he's attached correspondence from Genworth from that same time frame of August and July of 2018.
Next will be Mr. Robbins, Wendell Robbins. And if you two will.
Thank you, Mr. Farmer, for arranging the possibility for this presentation. My name is Wendell Robinson. I'm from Charleston, South Carolina. Professionally, I was a chartered financial analyst. I dug into the financials of companies to find out what's going on. My wife and I took out our policy in 2004. We paid basically level of premiums up until 2016. Then it went up by 12.8%. Then it went up by 19.9%. Then it went up by 20%, a total of 62.4% over the period of our policy. My comments initially are going to be repetitive of what people have said so far. I apologize for that. It's only useful to stack bigger comments for the purpose of this meeting. In the Post and Courier, our local newspaper, Genworth was quoted as having increased nursing care costs from $65,000 in 2004 to $102,000 last year. That was a 56% increase, which is 6.4 percentage points lower than the amount of the increase in my policy over the same period. Continuing in the same article, it quoted the statement from Genworth's board chairman that they have lost an average of $425 million annually over the last 5 years, and that the LTC policies, more increases will be needed to make their business profitable. The common element of insurance between both the issuer and the purchaser is a bit of a gamble undertaken in the manner to manage risk. I took out our policies in order to provide a financial hedge for our increased care versus the possibility of the cost. It's a gamble on both sides. They expect to get more premiums and get you and you pass off or whatever before they end up absorbing all your premiums and the earnings they earn on the premiums that you paid. Your gamble is that you're going to get more money than what you paid in terms of coverage. At this point, Genworth says their side of the gamble hasn't paid off because the increase in benefits that were higher than what they thought they were going to be. The respective positions of the two companies in this insurance contract are not comparable. The insurance companies use all sorts of data sources, historical trends, changes in health care, health costs, services provided, and the insurance companies use sophisticated actuarial calculations to project the expected future cost of the services and the policies that they provide. This is their business. This is their intellectual property. They are the managers. They're supposed to be experts. The individual policyholder has no such set of sophisticated professionals to quantify if, what type, or when we might need health care. We rely on the insurance companies because what the heck, they're in the business. They ought to know what they're doing. The policy premium ought to be one that reflects the cost that this actuarial sophistication has permitted them to know. This caused me some worry about Genworth as to its financial solidarity necessary to fulfill its contract with me should my wife and I need the benefits. So I took a look at their balance sheet and their income statement and financial statements over the last few years. The operating condition of the company is relatively flat, with an $8 billion plus revenue and a positive operating income range from $400 million to $1 billion, and a book value that was stagnated at $2 million over the last 5 years. The recent quarterly information provided by the company to shareholders in the market was the following, quote, long-term care insurance reported adjusted operating income of $21 million compared with adjusted operating income of $24 million in the prior year. Compared to the prior quarter and the prior year, results reflect higher earnings from in-force rate actions. I assume that means increases. The balance sheet has some interesting numbers to compare. September 30th, 2019 balance sheet. What I wanted to understand was how well covered insurance obligations compared to the assets to secure them. The total amount of cash and cash equivalents, think investments, and reinsurance recoveries was $91.7 billion, while the combination of future benefits, policyholder account balances, and liability for policy and contract claims equaled $73.9 billion, a positive difference of $17.8 billion, which seemed okay to me, but not necessarily robust. In the comments under the heading of 2018 company performance, in the proxy statement for 2018, offers the following performance metrics that the company uses to evaluate the performance of its management. Comments extracted from this proxy statement are the following. I'm not going to read the whole thing, just reading excerpts. Quote, we exceeded our internal targets for premium rate increases on our unprofitable legacy blocks of long-term care insurance and continued execution of our multi-year action filing plan. I think you probably know what that plan is. Further, under this category is the following metric related to performance. Now, understand they're using these things as a criteria for performance of management in terms of what kind of payments or incentive compensation they might receive. In our U.S. life insurance company, we measured incremental premiums approved for long-term insurance in-force rate increases and operating metrics. In other words, they're using those numbers to determine how well management is performing. Under the above introduction, there was a performance unit listing for key financial metrics, showing on a line for the U.S. insurance category of the business. This disclosure said, quote, gross incremental premiums approved for long-term care in-force rate actions 2018 target, $304 million. That was their target to determine the performance of the management. 2018 measured results, $394 million. In another section of the performance disclosures, two separate tables, these listings were provided. Income impact of certain LTC rate action benefits delayed until future periods, $31 million. And then in another section of the same thing, income impact approved for LTC rate benefits delayed until future periods is $85 million. So in other words, they got more than they thought, and they're going to use it next year, I think. The language is legalistic, so it's sometimes hard to determine it. Then I wanted to see how the management of the company was faring in contrasting to the customers were being treated in sizable premium increases needed so that the company could make a profit. The proxy statement provides a compensation table for executives, of which there are 5 primary ones. You can't see it, but this is the table that's in the SEC file document. In 2018, the 5 senior managers made 5,291,240 of stock awards, all of it going to the CEO. Plus that, a total of 6,510,665 in non-equity incentive compensation. The total category, which premium increases are a component. Total non-salary compensation for these 5 senior executives, it equaled $18,344,039. Now, what are the awards? What kind of compensation is included in the whole package for the executives? Salary, stock options, non-equity incentive plan compensation, which is what I've just been describing, company contribution to retirement plans, life insurance premiums, executive physical, and financial consulting. These guys are in the financial business, and they are going to hire a financial consultant to help them in their own financial affairs. And the company's going to pay for it. Now I'm getting to one that is really sensitive, and I apologize for my perhaps characterization of them. It comes from a financial analyst report that was put out February 1st of this year. So it's pretty current. On October 24th in 2016, Genworth agreed to be acquired for $5.43 a share by a privately owned China Oceanwide Holdings Corporation. Now that acquisition has been pending since that time. It's been held up by investigations and analysis of it from various entities in the United States, federal government, state government, and the like. However, so get that number, $5.43 a share. It's been reported that all of those things that were holding up this deal closing were satisfied in December of 2019. Here's a picture of the chart of the stock price. Since 2016, it's hovered a little bit above or a little bit below $4. Now the management cut a deal to sell this firm to a Chinese entity. All of the stock options that were issued during that period of time would have to have been priced no higher than the market, and some of them required at least 10% less than market. So they're doing a deal for $5.43, and they got options that are going to be accelerated as a result of the transaction at $4. I didn't have time to go through and calculate what the dollar amount of increase the management of this company will be putting into its pocket in partiality to our expense. But if you look at the combination of the flat line in the revenue and the flat line of the operating condition and the flat line of the balance sheet over this period of time, put that against their options and selling the whole company 5 years later, it really bothers me. I will close now with the following comment. I am keenly concerned about the financial well-being and solvency of this company. In the deal with the Chinese company, they were going to infuse $600 million for debt maturities. Furthermore, Genworth took an after-tax charge of $548 million, a $1.1 billion boost to long-term care reserves, and a write-down in tax-deferred assets. I'm keenly concerned about the financial condition of the company. We're relying on it to cover off all cost risks of declining health in our remaining years. However, I consider it to be unfair and inappropriate for premium increase is to be permitted in order for the company to make a profit compared to the situation of the premium increases that we have gotten. I don't think they're justified in making a profit while we are getting these types. Let's assume it's true that the rate increases have gone up so much that they got to get this huge amount of a premium increase. If that's true, I'm going to accept that, then I want to make sure that there's going to be enough money to take care of my premium benefits down the road. If there aren't, and this company goes bust, that all goes out the door. But I particularly find it galling by the idea that management, which is responsible for the mistakes in the first place, miscalculating the rate cost increase to gain millions of incentive income at my cost. Based upon this, I view, let's assume it's all even. The rates go up at the same rate the cost goes up. Calculate it in such a fashion that they don't make a profit, and take a careful look at who gets the benefit of what's going on. Thank you.
Thank you, Mr. Robbins. Well prepared. Okay, Kendall will read the next letter.
This is an email to Joe Cragen dated February 4th. Good evening, Joe. I've been trying to find someone to ride with me tomorrow to Columbia and have had no luck. The weather is supposed to be raining heavily all day tomorrow, and I not only dislike driving on the interstate, I dislike driving by myself and in bad weather. With that said, I regret to say I will not be coming tomorrow. I wish there was some way to participate remotely. I know it most likely is a hardship on others to attend if they do not live locally, but I am thankful that Director Farmer has requested this public hearing. I went back and did some research on the premium history on my long-term care policy. I purchased my Genworth long-term care policy in 2006 for $2,835, and the premium has increased 62% through the end of 2019 to $4,605. Genworth was granted a 20% premium increase in 2014, 2016, and 2018, and now they are requesting another 20% increase for 2020. At this rate, no one will be able to afford to keep their policy. I vote to suppress these continued requests by the company and just say no. I hope you have a good turnout tomorrow and a favorable outcome for the residents of South Carolina by denying these constant rate hike requests from Genworth. Sincerely, Mary Ann Karakides from Greenville, South Carolina.
Okay, thank you. And y'all have the opportunity to okay, thank you, Kendall. Mr. McCarthy.
As my wife says, I'm Irish and I have a tendency to talk too long, but I'm going to try and keep it a little bit short because everybody in here is pretty much in the same boat. And I'm sure y'all feel a little bit of heat right up here in the front row, and honestly, you should. Let me start off with one question to Mr. Farmer. I looked this up on your website about the meeting. I saw the article in the Charleston paper, and then I followed up on it. How do you notify people? How are people notified?
So, as we said, this is our second experience at this. So we notified the public, number one, by a press release. We put it in, anybody have an idea on the number, in 3 publications statewide. We had an interview with the Charleston paper, and that produced a lot of interest. And for those people that had contacted us in the past number of years, we contacted them personally.
Okay.
By phone.
I would I'd keep it short. I know Ms. Franklin here, and we have other agents in here. If somehow you could set up a system, because according to your notes, or according to your information, we have 15,532 individual policyholders, and we have 796 group policyholders. My clients don't know about it. The only way I know is to keep up. I'm a licensed insurance agent in South Carolina. If you could somehow get in there and say, okay, he's written long-term care, can we put out a blast email saying we're having this meeting? because in the Charleston paper, it did not state the dates. And I misunderstood that. I went on vacation, came back, and was looking, I was thinking February 15th. I just caught this. But that being, I just want to pass that on.
We will improve as we go, and
Okay.
I've already corrected 4 papers instead of 3.
Okay, appreciate that. My second question is, have you had an increase, or have you had an inquiry to increase anything from Northwestern Mutual, Mass Mutual, or Mutual of Omaha? Can anybody tell me?
We will get to that answer before you leave.
Okay, because I personally, my mother has a Genworth long-term care policy. I'm in the same boat as everybody else. She started in 1999, $2,493 in premiums. We ended up in 2018 at $5,300. I kept getting the notices. I kept paying them. I understand this. I'm a financial advisor, okay? As Mr. Dillon stated earlier, there are 2 ways you make money. You take in the premiums and you invest the money. As a financial advisor, if I invested the money this way, I'd be fired. I would be out of a job. I'm sorry. You can't keep coming back to the well. You're coming back to the clients here who have these policies, and you keep coming back. When he stated a cumulative increase from 1998 on 2000 for the PCS2, cumulative increase of 172%. These are usury numbers, folks. I'm sorry. This is not payday loans. These people come in here, and when I do a policy, I do just like every other agent. I figure out what their assets are, what the pension is, what their Social Security is. How am I going to pay for this when they're at about age 77, when that's the average that they're going to go into a facility? Are we going to be able to use it at home, or are we going to have to pay it out all the way? So we do that math. All the agents, we sit there and figure this out, and then we come up with, okay, here's the benefit I want, here's a premium, can you pay it? Nothing personal. You're out of our network. I will not write your policies anymore. I will write policies in specific instances where it's appropriate for the client, and I think that we're going to be able to get through. I have not had any increases on my mutual policies. I have had serious increases on your policies, as you well know. You're going to come up here and try and justify it, rightfully so, you're an insurance company. This gentleman over here, Mr. Robinson, CFA, you don't get any higher than that as far as analytics. He's done the math. All the people in here, I'm very impressed by the sophistication of some of these people who've come in here and done the research. But you've got to go back and say, we're getting hammered here. We're getting beat up. You've got to figure out a different way to invest the money. Basically, and I also want to get rid of this idea that it's the increase in long-term care cost. No, it's an increase in your ability to pay the benefit. If I have a client who's getting $3,000 a month and they go into a facility, Frankie Home in Charleston, Mount Pleasant, it's $6,000 a month, I got to figure out the way for them to make up that other $3,000. If Frankie Home goes up to $6,200 a month, you don't make up the $200. The client makes up the $200. If you have the inflation protection in there, when I bought it for him, when I got it for him, that you have to do, you have to invest the money. Now, we've got Principal, gone. Met, gone. Allianz, gone. Name some of the other companies, they're gone. You got Genworth still in here, you got Prudential, which was very surprised about, but I think the reason Prudential is still listed in here is because they were the state plan for the state employees. I have a lot of teachers who, when I advise them and I did reviews with them, they're talking about long-term care. I said, go to the state. You can get a much better premium than you can with me on a retail policy. Now they're coming back at me and they're about to get hammered. So I want you to sit and look at this for all of you out there. This is basically what we call the law of large numbers. What they wanted was, like a term life policy, they wanted it to get to a point where, number one, they thought the client would die. So acceptable. It's an insurance company. They're supposed to make money. Number two, it get to a point where they quit paying. And that's what's happening now. I'm getting too many clients coming to me going, I can't take this anymore. And this idea of coming in and saying, okay, you can still pay the premium or reduce the benefits, that doesn't work for me or the other advisors. That's not how we built the policy. We came in and said, well, you can afford this. Now you can't afford this. So in summation, basically you oversold, you underpriced, you did not invest the money properly. I know it's not your personal fault. You've got to come up here and defend this. From my point of view, Mr. Farmer, I've seen too many increases on Genworth. Too many. I don't think they can justify it. After looking at Mr. Dillon's slides, it's just, no. And choice one and choice two, these are all in those slides, those are all type of products. A 2003 product that's had a 62% increase cumulative, please, I'm sorry. But I've stated mine, and the gentleman over here, the CFA, you talked about the stock price. If you're really interested, folks, go on to the SEC and look at what the payout is on the chief executives. I won't go over that here. I don't want to embarrass anybody, but it's disconcerting. Thank you.
Okay, for the record,
Yes.
did we get your name and,
My name is C.J. McCarthy. I'm with Oak Capital Management in Mount Pleasant, South Carolina.
okay, and to answer your question
Yes.
about those three companies,
Yes.
there's nothing pending.
Nothing pending. Thank you. Appreciate it.
Sorry. All right, Joe, another letter.
Okay, this is from Mr. Thomas Cameron, who's from Camden, South Carolina. And it was sent on Monday, January 27th, 2020. It was addressed to me. Hi, Joe. Thanks for letting me know about the Genworth LTC public hearing rate increase on February 5, 2020. Although I will not be able to attend, I would like you to read my thoughts aloud to the representatives from Genworth about the LTC premiums. I bought an LTC policy for me and my wife in May 2001, and since Genworth has taken over our policies, our premiums have gone up and up. In 2014, a 20% increase. In 2016, a 20% increase. In 2017, a 20% increase. And in 2019, still another 20% increase. That looks like an 80% increase, but if you do the math, it's more like a 107% increase, because the last increase was on top of the other 20% increased premiums. And now they want more. Look, these insurance companies are not stupid. They knew, and even the salesperson told me, that LTC costs go up every year. So the insurance company knew what to expect, but yet they sell their policies at a lower rate to hook you in and then raise rates on everyone down the road when they are about to retire or have already retired on a fixed income, which is my case. And guess what? Last year when I got my notice of the 20% increase in premiums, they had the audacity to say that they plan to request at least 150% in additional premium increases over the next few years. So if you do the math, that proposed increase and the other one that will follow next year would be getting close to 300% increase in a few years. Please say enough is enough, and, paraphrasing, heck no to this proposed increase, and to others that would follow. There's a lot more I could say, but I'm going to cut it off here, except these greedy people make me sick, and I've got a deal for them. Pay me back 100% of the money I've paid in premium on my wife and my policies, and we'll call it even. Good deal for me, but it seems like a great deal for them. Joe, please confirm you got my email. If I don't hear from you, I'll resend it. Thanks, Thomas Cameron, Camden, South Carolina.
Thank you, Joe, and just for the record, I was the one that asked Joe to edit that nice quote. Now we would hear from Mr. Barrett. Again, let us know your name and your town.
Buck Barrett, I'm from Chapin,
Yes, sir.
and I want to change the train of thought here.
Yes, sir.
Genworth called me and asked me if I'd come down and say, let you folks know what kind of service I've been getting. And I'm happy with the service, so I felt obligated to come down and say, hey, here it is. In 2002, at the insistence of my wife, I've never been a big insurance fan, at the insistence of my wife, we both took out long-term health care policy. In 2012, she was diagnosed with Alzheimer's. The folks at the doctor's office said, hey, you're gonna need some help. I don't wanna go to nursing home, but you're gonna need some help at home. We went to the insurance company, Genworth, told them what the story was. They contacted the doctor. The doctor sent her part in, come back and proved care 24/7, 5 days a week, plus a 1 day, 8 hours a day for household maintenance. That was a big help to me because I didn't use the whole thing, but knowing it was there, it was a big relief. The next year, it steadily got worse. Went back to the doctor. The doctor went in to the insurance company. Genworth came back at that time, approved 24/7 plus the 1 day for household maintenance. So I've got care for the wife at home 24 hours a day, and most of it right now is coming from Genworth. Granted, they have increased the policies, and I don't have the figures there, but one nice thing on the wife's policy, they canceled everything as soon as they started paying us. They canceled our policy, no more premiums. And it's not, you hear the horror stories from filing for insurance companies, with insurance companies. This did not happen with Genworth. I get a monthly check from them as long as I submit the necessary paperwork, which is quite a simple process, and we go in like clockwork. And hopefully we can continue that way for a number of years. That's all I have. Any questions?
Mr. Barrett, that was, we appreciate you coming. That was a great testimony. The company is doing exactly what they said they are supposed to do. And it's refreshing to hear. You're experiencing an illness that we all address at some point in time, and it's good that you're getting the help, and it's good that the company is abiding by their contract.
Thanks.
Thank you for coming.
Sure.
Okay, Kendall, would you read the next letter, please?
Director Farmer and Director Cleary, I want to thank both Director Farmer, South Carolina Insurance Commission, and Director Cleary of Genworth Life Insurance Company for their responses to my January 27th, 2019 letter. All 3 documents are attached to this note. Unfortunately, as with all previous court responses, each avoided answering my questions. In particular, my January 27th, 2019 questions remain unaddressed. 1. Why did my policy increase 107% in 5 years, from 2014 to 2019, when the Genworth site provided only a 15% increase over the same time frame? Even going back to 2004, the Genworth site shows only a 67% increase from 2004 to 2018. 2. Why does Genworth promise to request another 150% increase in my policies by 2026, while the Genworth website predicts only a 24% increase in costs during the same time period? 3. Why does Genworth predict that my policy will increase 416% by 2026, whereas the Genworth website indicates only a 115% cost increase during the same time frame? The argument in both of these letters indicates that there are other considerations that justify the rate increases on my policy. I would be interested to see these other factors that will result in my policies increasing at a rate 4 times higher than the Genworth website indicates. Director Farmer missed this point, focusing on the current 107% versus Genworth's 67% increase, rather than including the 2026 prediction differences. Is the Genworth site deliberately misleading in order to capture more business by duping prospective clients into believing that premium increases would be reasonable? As I stated before, this looks like a basic bait and switch scheme. The reviews provided by Consumer Affairs tell the same story 240 times with a rating of about 1.3 out of 5. I am not the only one being ripped off by Genworth and the respective state insurance commissions. I am willing to bet that Director Cleary has a lot of practice writing letters such as the one sent to us. I wish the information had been available to me in 2003. It was reassuring to read in Director Farmer's letter state that Genworth was charging hugely inadequate premiums for long-term care. Director Farmer goes even farther, calling the long-term care policy pricing as errors by Genworth. This has been my point since my first complaint in 2014. Namely that GE and then Genworth simply did not know their own business. Unfortunately, Director Farmer's Insurance Commission allows these errors to be corrected at my expense, in backroom meetings not open to the public. This backroom process permits Genworth's incompetence to be rewarded. Unlike all other industries, with the exception of utilities, the long-term care insurance industry does not have to know their business to stay in business. The Insurance Commission gives them a pass on competence and thinks they are protecting me by only allowing 20% per annum increases. Somehow, Director Farmer thinks that I am being protected from the requested 55% and 70% requested increases from Genworth. I explained in my January 27, 2019 letter, as a fixed income retiree, these increases are not sustainable. Based on the South Carolina Insurance Commission rubber stamping actions over the past 5 years, we can expect similar increases for the next 6 to 8 years as promised by Genworth. At this rate, the policy cost in 2026 will be approximately $8,500, nearly 3.6 times more than in 2013. If we enter an assisted care facility in 2032 at age 80, the annual premium can be estimated at nearly $15,000. In the year 2032, we will have paid an estimated $170,000 total. At this stage, I want out of this ridiculous process. The policy change options offered by Genworth are not acceptable. Genworth's real goal is to price people like us out of the unlimited time coverage policies. Simple bait and switch tactics. Let's stop this useless back and forth and do the following. 1. Director Cleary, I expect Genworth to close my policies and return all of my premium payments. Genworth can keep the interest earned. I have lost all confidence in Genworth and do not want to do business with them now or in the future. 2. Director Farmer, the SC Insurance Commission should reevaluate its charter to protect the citizens of South Carolina. Increases of 20% per annum protects only the insurance companies. 3. Director Farmer, please reconsider accepting awards from insurance agents. The implications are not helpful to your organization. 4. I, for one, will continue to speak out against Genworth and the process that allows them to prey on people that are trying to be fiscally responsible. Regards, Nick Martin of York.
Thank you. A couple clarifications. The Director Clary referred to in letters a Genworth executive. As you can tell by this morning's hearing, there's nothing being done in anybody's background. And the comment about please reconsider accepting awards from insurance agents, I appreciate the comment. Okay. So our next citizen is Ms. Laymire. And I probably butchered the last name, so you'll correct me.
Very good. Most people don't say it correctly, so thank you.
Thank you. State for the record your name and where you're from.
Peg Laymire, Lahmeyer. Nobody can spell it either. Well, good morning, and I just want to speak from the heart. I have enjoyed hearing all of the other people speak, and everyone has valid concerns, and my husband and I are policy holders with Genworth, and have been since 2005. And we are concerned very much about the rating increase. First of all, we purchased our Genworth policy because I got in trouble with someone a few minutes ago. And I'm from Somerville, South Carolina. So, but we purchased our policy trusting what is now Thrivent Financial. But formerly, when we purchased our policy in 2005, it was Lutheran Brotherhood and Aid Association for Lutherans. Obviously, we're Lutheran. So, so we had a trust in that fraternal organization and knowing the policies and the companies that would be wonderful. And they must have been right, because Genworth is still in business, whereas a lot of other companies are not writing long-term care policies. So I want to thank you up front for Genworth for hanging in there with the industry and still providing the coverage. Although we don't want the rate increases. My husband and I are 75 and 76 respectfully, and we are beating the odds, and I don't want to jinx ourselves and fall down the stairs later and have to collect on my policy, but we are still working full-time and have no desire to, well, my husband probably has a desire to retire, but I do not. And I want to speak as a provider of services too, because I do work for a nonprofit organization called the ARC in Somerville. And we serve 5 counties of South Carolina with respite services and education and outreach services, which I'll mention in a minute. But as a personal policy holder of Genworth, Obviously our premium has been raised over the years, and we're keeping up with it. But my big concern is if we continue to have those big rate increases, when we do stop working and have to live on our fixed income of Social Security and a few little investments that we have, how are we going to afford those policy increases over the years? So I would really like for the Insurance Commission and Genworth to consider that as a concern for those of us that are actually beating the odds, and perhaps there could be some type of, I don't know, insurance and all the ins and outs of that, but consider possibly a consideration for those of us that have, like he says, 77 is the average age somebody goes into a nursing home. Well, I don't plan to go at 77. And nor does my husband, who's just a year away from that. So, if that could be a further consideration now that, looking at those ages, because people are living longer, people are working, because we find, working in the world of Alzheimer's and dementia that I do, that if people will stay in a job or volunteer and stay active, they will not, have those health concerns possibly, because it's very important for us to stay active. So, like my daddy always said, I have to have a purpose to put my feet on the floor every day. But maybe look at those possibilities of those of us that are aging in those policies that we've had since we acquired ours in 2005. So, and it was a minimal policy based on our income needs. And so we just want to express our concern, that that's going to hurt us when we do finally retire at whatever age. I probably won't ever retire in my job. I love it. Which brings me to being a respite provider. The ARC is 24 years old. We've been providing respite services to families, education to both caregivers and law enforcement and professionals throughout that 24-year history to 5 of our low-country counties. And we see every day the need for long-term care insurance. We educate at the first opportunity we have families to, if they have younger children, younger people taking care of their mother and father or grandparents, please go talk to your insurance agent about long-term care. It's cheaper now for you to do that than later down the road, and you're experiencing, because their parents don't have it. And how are they going to possibly pay for the increased cost of nursing care and such as that? Mr. Barrett was very wonderful to share his story about his wife needing to access those services, and the fact that the premium has stopped now because one of them has accessed those services. But I see it every day, and we also have several families that are in our program that are utilizing their long-term care for that daily respite time in our wonderful place. But not enough, because we only charge $45 a day for a half-day program. And some people can't afford that. They don't have the insurance, they don't have the extra income. And so we offer scholarships because we are a nonprofit. No one is turned away. But it would just be wonderful if we could entice the younger generations now before us to be able to purchase long-term care policies, and how they're going to do that when they're still raising a family and the insurance premiums are so high. So I hope that you will consider that, Director, in your conversations with Genworth, and help these insurance companies understand that they need to think about that consumer. I know your costs are going up, but then so are ours too. And so I would just like you to consider that as you go forward. And that's all from my heart. And I know it's a tough job, but thank you for doing it.
Thank you, Ms. Lakeman. Truly, that was from your heart, and your dad was a wise man. Now we would like to hear from Ms. Franklin.
Thank you, Director Farmer. I'm Barbara Franklin. My company is Franklin and Associates. I'm based in Charleston, South Carolina. And I'm here with a colleague, Loretta Hartzell. Her company is Hartzell and Associates, and she is in Greenville, South Carolina.
Excuse me, ma'am, could you stand at the podium, please, so we can...
Do I have
you
to?
up?
I'm not a podium person.
But when you do, be careful of the wire behind you.
Okay. Is it all right to stay right here? Okay. Podiums, I'm short, and so I don't feel people
All right.
can really see me.
You'll get comfortable.
All right, good. It was in 1990 that I first stepped my toe into the world of long-term care insurance. And Loretta stepped in about a year after that. And some of you may know that this all started, Amex Life Insurance was one of the very first companies offering long-term care insurance in South Carolina. And Loretta and I were career agents with Amex, which later then became GE Capital, which later became Genworth. So naturally, we have almost a 30-year history with this organization. But we did later become brokers because we wanted to have a wider range of companies, a wider range of products. But we've stayed close to Genworth all these years. And bringing our years of experience as a specialist to events like this. We attend conferences every year. We talk to Genworth and other colleagues from around the country continuously. And of course, we've been well aware of all the issues that are being discussed today, the morbidity, mortality, lapse rates, interest environment. We've been educated about that over the years, but I have to admit, Mr. Dillon shared some interesting nuances that we were not educated about previously. I do want to say that while the premium increases are happening, there is one bit of light at the end of the tunnel, and that is the hybrid policies that are now being sold. Mr. Dillon referred to those. Those are policies that combine life insurance with either long-term care with either life insurance and annuity. Those are guaranteed never to increase. Now, they're too new to know how this is going to stack up, and I'm a bit skeptical that that's what's being sold, and Mr. Sullivan, who spoke earlier, may find that of interest if he's looking at coverage and concern, because it is a guarantee. Now, on the personal side, Loretta and I both own long-term care policies ourselves, and so do many members of our family. Loretta's mother used her policy in Ohio when she was in a nursing home. My father-in-law is using his in Louisiana right now, and my mother moved 30 days ago to an assisted living facility in Charleston, and very good likelihood that we're going to initiate a claim quite soon. So we are witnessing, unlike some of you in the room, we're witnessing these issues from both sides of the table. And at this stage, while we still sell insurance, Loretta and I spend most of our time in the servicing end of things. We, of course, help people who are using their policies. Claims coming out the woodwork. We're involved with initiating a claim, helping people through that process. And I was glad to hear the report of a claim that has gone really well. We find that to be the case as well. But as you can imagine, our days are filled with premium increase discussions. Day in, day out. Letters, phone calls, emails from discouraged, angry clients of ours, people that we've known for a very long time. And we're not just hearing them in a public setting like this. We're sitting in our offices with meetings that can go on for hours at a time. It's painful. It's disheartening, especially when you're not the insurance department, when you're not the company, and you have little impact on this. You're really caught in the middle, I'm afraid. Now, Loretta and I have identified a problem that we think emanated in the very early stages of this industry. And it's a problem, I don't think it's so much with the carriers, although maybe some of the language and brochures could be a factor. But as career agents with Amex, we were trained to personally deliver policies, which we still do, and to point out that little paragraph on page 1 that says, we will never increase your premium due to changes in your age or health, but reserve the right to do so by class and by state after appropriate notice. We said that over and over again, and later on there is a piece of paper that actually has to be signed by an applicant acknowledging their understanding of the potential for premium increases. I'm sorry to say, but agents and brokers who were not trained as we were found it very easy to overlook that. And of course, we did not experience, Loretta and I did not experience a premium in our book of business from 1990 till 2008. So sure, it was easy to overlook it and say, oh, this will never happen. But it has happened. And I can't tell you the number of people that have said to me, and Loretta the same, well, I was told it was never going to increase. Well, who is doing that telling? And that is a big problem that we're dealing with today. And when you think about it, what other kinds of insurance? Health, car, homeowners, those all increase. So why would someone have that in their mind? Someone told them that, and it was completely inaccurate. Now, we are grateful, Loretta and I both, for the 20% cap that has been imposed by the department for a number of years, because we are licensed in many other states, have clients in other states, and we see the kinds of increases. I was asked to help someone whose policy I did not write, but they moved to Charleston from Virginia with a 71% increase, not Genworth. They were astounded. And so we see those and realize our 20% cap, even though it can result in more increases later, is at least something not quite as onerous. Now, I did my own little experiment. I wanted to see, based on current rates, if I bought a policy at current rates, at the age I was when I bought mine, which was 42, I'm 71 now, in case you want to do the math. So a person age 42 buying a policy today, now I can't replicate that policy because I have lifetime benefits, which I'm not going to give up. Sorry, folks, it's not going to give that one up. So I can't replicate that because lifetime benefits aren't sold now, but I replicate as close as I could. And the premium that I'm paying now, even after 5 increases since 2008, would be 400% more. So someone made a statement earlier about buying a policy today. No, first of all, I would have to give up benefits that are very important to me, and the premium would be substantially higher, at least according to my little experiment. Needless to say, that kind of disparity makes it really hard to sell policies today with those kinds of rates, but it does give one a bit more confidence in the stability of premiums going forward, knowing the course corrections that have obviously been made. Now, I have to say, too, in the past, Loretta and I have actually been proactive about premium increases. We don't know that other agents do this, but we decided to. We sent letters to our policyholders saying that this increase is coming, you're going to get a notice about it, and we would invite you to come and meet with us to review your coverage, and let's consider some of the options, because there are options that Genworth doesn't necessarily tell you about that we know of, that we have access to because of software that's given to us, and many clients take us up on that offer. And they can, of course, adjust their daily benefit, their monthly benefit, their lifetime benefit, adjust their inflation. My mother, when she was 89, I removed the inflation protection from her coverage. She had a daily benefit that I felt was adequate. She had income that I felt was adequate. I removed it. Now, that was never displayed in any of the options that Genworth sent, but I knew it was appropriate for my mother. So I think when someone's life circumstances change, you can make these adjustments and feel good about it. Our clients do find it helpful for us to review the policies, and Loretta and I just know that this is the best course of action for us. We cannot make the premium increases go away, but we can help to mitigate it and make it a little bit better, and just be there for our clients. Many of them who meet with us about the increases say, I don't think I'm really going to change anything, but we're just glad to know that you're there for us. And Loretta's had the same experience. They just need that one-on-one. And I'm afraid, Director Farmer, that's missing in a lot of cases. So what about those who don't have an advocate then? I do want to commend Genworth on that point, because you do have an 800 number dedicated to premium increases, not policyholder services, but dedicated to premium increases. That's very effective. I've called it myself, and someone who can't get me or Loretta could contact them. And I do want to commend Genworth too for the almost $9 million a day, I understand, you pay out in benefits. It helped Loretta's family, has helped my family, and of course many others around the state. And Genworth has remained committed, as Peg said, to be a leader in the industry. And although the hybrids are out there and it remains to be seen where we're headed, I feel, as others do, that without Genworth, there wouldn't be a long-term care insurance industry. You're needed. And I'd also like to commend Director Farmer for having these meetings. Today was the very first time when I saw your logo and it said, where protection and regulation meet. And I can really say that having meetings like this is a real testament to meeting that commitment. So Loretta and I appreciate the opportunity to be here.
Thank you very much for your presentation. That is the list of people that have signed up that indicated that they would like to do. Is there anyone else here, citizens that would like to make any comments? All right, and we're also fortunate to have another advocate with us, Teresa Arnold with AARP. Has been a good friend to the department and to the citizens we've served. So Teresa, we appreciate you being here.
Thank you, Director Farmer.
And be careful of the cord.
Thank you, because I would trip on it. First of all, I want to relieve your mind to let you know that I will only speak for a couple of minutes because I know y'all been here a long time. And I too want to thank Director Farmer for holding these hearings. I don't know that this was as common in years past, but this is extremely helpful. And if nothing else, as consumers, you get to say what's on your mind. You have a venue for that, and it's with the company. So I think that's very, very helpful for everyone. ARP over the years has learned, just as consumers have, that long-term care insurance policies have cropped up a lot of problems. And so we've developed recommendations for strengthening long-term care insurance policies. But that's not really helpful here today when you're already in it. I do want to let you know I'm the state director for AARP. We have 600,000 AARP members in South Carolina. And we're also probably the biggest consumer protection advocate in the state. I don't know if you've seen some of our work fighting some of these utility rate increases and the nuclear power plant. We've really been real involved with that. Right now we're involved in the Blue Granite water utility rate hikes. And the reason, of course, that we're able to do that is that we can harness the power of our members to come and vote, to talk to legislators. The other thing that I want to say with the long-term care insurance policies is that each of you in this room that has purchased one in the past, you were the smart consumer. I saw your eyes. You're thinking no now, but you were actually doing what everything in the industry said was the prudent thing to do. And so I would never want anyone to think that they weren't doing the right thing at that time. There certainly were a lot of things that happened since then, and one of them is that we've had the lowest interest rates on earnings for years and years and years, which I don't think anybody could have guessed many years ago that would have been the case. Regardless, we stand ready at AARP to help on consumer issues, to help on these issues. We would like to partner with the Department of Insurance for any kinds of improvements or help that's needed for the customers on these long-term care insurance products. And I do see some familiar faces in the audience, which is really nice. The other thing that's hopeful is that we're all actually healthier. I know we don't always think that, but we're all actually healthier. There are fewer percentages of people going into nursing homes. And I hope from the bottom of my heart that none of you have to be in a nursing home. But I do want you to know that I have a study here, and I brought a couple of extras about disrupting the marketplace, the state of private long-term care insurance 2018 update, and happy to share that with anybody here. And I again commend you for doing the right thing and also for coming here and speaking out, because as a regulatory body, they need the strength of the consumer supporting them in whatever actions they're taking. That's an important component, I think, for the regulatory body to have. And I'll hang around for a few minutes if anybody has questions or if there's anything you think that I can help you with. I'm very happy to do so, because I think it's a really horrible situation. I've had calls myself from AARP members when they say, you know, I've paid for years and now I can't afford any part of the premium and I'm going to lose every single bit of my benefit. And that to me is a very harsh reality when you've been really, really responsible. So anyway, thank y'all very much.
Thank you for your partnership and your appearance this morning. So if no one other members of the public would like to speak, we're now moving into the third portion of the hearing. We've heard the department speak. We've heard from a number of citizens, and now it's time to hear from Genworth. So with us this morning, we have three representatives of Genworth, and I'll read the cards so I'll make sure I get the names right. It's Andrea Lynn White, is the Senior Vice President and Chief of Staff of Genworth Financial. Mr. Warren Jaffe, Director, Government and Industry Relations. Mr. Matt Kepler, President, Long-Term Care Closed Block of Business for the U.S. Companies. Ladies and gentlemen, we appreciate your coming. We'll let you divide up among yourselves who's going to present first. But we appreciate you being here. You've heard from the department, you've heard from the citizens. This is a big deal to us. You know, these are heart-wrenching presentations that have been made. You know, you have seen this probably countrywide. This is folks in South Carolina that have issues and have concerns and are concerned that we're being priced out of the marketplace. So welcome. Looks like Ms. White wants to be the first.
Thank you very much. And is this a clicker here?
It's up on.
Oh, great, thank you.
And I will caution you to be careful with the cord as well.
Oh, yes, thank you so much. So let me first say good afternoon to everyone here, to Director Farmer. I want you all first to know that Genworth is exceptionally pleased to be here to hear your issues and concerns. We thank you too for putting the consumers first. We've been in this venue before where the company has gone first, and it is very good to let you say what you need to say so that we hear it. And we did listen intently. I want you to know that our team of people that are here today are willing to stay afterward to speak to each of you individually, because we want to hear your concerns and we want to be able to provide information to you. This forum is simply outstanding. It is necessary. Your issues are real, and we understand that. Now, I thank every person who came here today, particularly those policyholders, for your engagement and interest in your future and in your engagement and interest in what's happening with your long-term care coverage. It's necessary that you be engaged, so the more you know, the better informed your decisions can be. Now, Director Farmer mentioned that I am the Chief of Staff. I'm the Chief of Staff to Genworth's CEO, Tom McInerney. And Tom sends his utmost regrets for not being here because he normally would come. Tom speaks to policyholders often, in fact, very frequently, who call to Genworth or to write him directly. The calls and conversations can go on for long periods of time, and he does not permit anyone to stand in the way of his direct access to policyholders. So I want you to understand that today, and it was definitely an unavoidable conflict that led to his absence today, that he actually tried to move to get here. So I wanted you all to know that as well. Now, we recognize that long-term care insurance serves a critical need to help individuals and families when they require care for extended period of times. We also recognize the challenges that are posed by the premium rate increases. And we hope this afternoon to provide some information about why the increases are necessary and the options available to you, to anyone who is facing a rate increase. Now, I'm going to start quickly, let's see. here with the fact that long-term care insurance coverage is valuable. Many of you understood that at the time that you purchased it. There is a need because I believe it was Ms. Siegel who was mentioning baby boomers. The population is aging. We expect the population age 65 and over to grow to 84 million by 2050. And the number of people age 65 and over with dementia disease is projected to reach 7.1 million. And that's about over 30% increase and is since 2018. And spending by the federal government will increase as well, as we're going to 3% of GDP from in 2050 to about 1.3% in 2010. Now, the cost of long-term care is also rising. We've been talking about that today. The median cost of a private nursing home room in South Carolina is $91,000, and an assisted living facility in South Carolina, $42,000. And we note that the average cost of a long-term care event is $174,000. This is average cost, and we juxtapose that to the average retirement, the median retirement account balance of $135,000. So clearly, there is a need to plan. We also note that labor shortages and wage pressures have driven the costs of home care up quite substantially. We've seen the biggest increase in that year over year as a result of those factors. Now, you heard Mr. Barrett and others speak about the leverage that long-term care insurance affords. Just generally, I'm speaking generally and not just Genworth specific now, but certainly you have access to benefits that far exceed the premium that you pay. So we definitely encourage people and families to prepare for these significant costs and that they be a significant component of retirement planning going forward. Now, I wanted to just chat with you specifically about Genworth's position. We are, in fact, the largest. We have the largest LTC block in the industry. We service 1.1 million policyholders, 18,000 of which are South Carolinians. And we are currently managing 50,000 active and pending claims. And 1,100 of those claims will be for South Carolina policyholders. Genworth has incurred significant losses to date on its legacy LTC businesses. Other carriers have as well. And those losses amount to, and I think it was Mr. Robinson who noted, an average of $425 million over the past 5 years. Now, those losses cumulatively are $3.6 billion that Genworth has lost on these policies. And those losses will continue to grow, and they will not be recouped. Every dollar of long-term care premium, every dollar of rate increase, all long-term care reserves, and the remaining statutory capital that Genworth has in the entity that insures South Carolinians, that amount is $2 billion, will be used to pay future claims. And I want to be sure that that's clear. We are seeking the rate increases to reduce the amount of future losses, which we hope to bring closer to break even, which means that $1 premium in would be used to pay $1 claim out. And we want to ensure that every claim for every Genworth policyholder is paid. Now, I heard Tom McInerney, our CEO, say in a forum just like this just over 2 weeks ago that he hopes to ensure that the very last dollar of claim for a policyholder in our legacy blocks is paid by Genworth. That is the objective, and that is the mission that we're on. We appreciate that this is difficult, and I want you all to understand that. We're going to talk more about that, but I want you to have a broader understanding of what is leading to the circumstances that we're in now. So Matt Kepler, who is the president of the closed block for Genworth, is also an actuary, as was Mr. Dillon, and he can provide, I hope, a very simplistic explanations for what is a very complex issue for you this afternoon. So Matt, I'll yield to you, and then I'll be back.
Just be careful.
Yes.
Kelly, you may want to record on the way.
Okay, thank you. And once again, I would like to thank all of you for taking the time today to come and share your concerns, and Director Farmer for taking the time to set this up. Again, we take this business extremely seriously. We understand the challenges that premium rate increases inflict on our policyholders, and we want to do everything we can to help consumers through this situation. So before I leave this slide, just a bit of background. I'm Matt Kepler. I've been with the company for about 5.5 years. I joined in 2014. Basically, since the day I walked in the door, I've been hyper-focused on addressing the problems of the existing long-term care insurance business. My primary job is to do everything I can to ensure that we are able to pay claims in the future on this block of business. So while the frustrations expressed today in this meeting and by policyholders across the country are certainly understandable and justified, I want everybody to understand that we're focused on doing everything we can about the future. Unfortunately, we are where we are, right? Nobody would have preferred for the situation that we're in to have happened. As you've seen, Genworth has lost $3.6 billion. Certainly, policyholders are not happy to have received the significant premium increases that have been required. But again, as I look at my job of protecting Genworth's claims paying ability moving forward, I can tell you the only way that is possible is through the approval of actuarially justified rate increases. We've been exceedingly clear in our external disclosures to market participants that we are heavily reliant on the rate increases that we've already achieved, and more importantly, on rate increases that have not yet been approved. So earlier this morning, our company released its fourth quarter 2019 earnings results. And during that presentation, we mentioned a couple of facts. One of those facts was we are reliant on approximately $7.5 billion of future rate increases that have not been approved. So those rate increases that we will continue to pursue across the country. We do travel to virtually every jurisdiction state across country. We were on the West Coast on Friday giving a similar presentation. So again, we're hyper focused on that. The other factor that I wanted to talk about was our CFO, our Chief Financial Officer on the earnings call today, mentioned for what was a repetition of what has been said on several prior calls, which is we expect that all of our investors will value our U.S. life insurance business at zero. That means we have committed all the statutory capital in the business together with all the future premium increases. All the reserves are for the benefit of policyholders. We are managing this company for the benefit of policyholders. The premium increases that we are achieving, again, go to pay claims. They don't go to pay stockholder dividends. They don't go to pay executive bonuses. So we're managing this company to pay those future claims. I do want you to also understand again, as Lynn mentioned, the leverage in this product. Again, there's no denying, right? No one likes to get a rate increase, whether it be on a utility or an insurance product. And certainly the percentage increases that have occurred in the long-term care industry are as high or higher than any other product out there. However, that's largely due to the fact that the people who bought this policy originally got the greatest deal in history. In hindsight, knowing what we know now, they paid far less than what they should have done. This was unfortunately not evident to the insurers at the time. Again, at that time, historically over 100 insurers were in this market. I can tell you 100 insurers did not intentionally go out there to underprice a product. This was, well thought out, well researched, and unfortunately wrong. Even smart people can make really bad predictions about the future, is what we've learned. Also, just a reminder that these products are heavily regulated. When we went out and developed these products as a company originally, we filed them with individual states before they could be sold. We had to have them approved by basically each regulator across the country. again, it was not evident to those regulators that there was a deficiency in the premium. They would not have approved the premiums had they, the products at that time, had they done so. So we're doing everything we can. At the end of the day, we cannot control the cost of the care, right? Long-term care insurance is becoming exceedingly expensive because the cost of the care itself is becoming exceedingly expensive. Genworth and other insurance carriers are simply an intermediary between the policyholders and the cost of care. We cannot control the cost of the care itself. We can, however, and do want to do everything we can to work with policyholders to make their situation as optimal as possible given where we're at. We do think the leverage of these policies is still very, very significant, even after these rate increases. I think you would be hard pressed to find a policyholder or a loved one of a policyholder who has claimed under their long-term care policy that regrets having bought it. Almost, the vast majority of policyholders who end up claiming will get far more back in benefits than they ever paid in premiums. So it has turned out again to be a tremendous financial decision, tremendous positive financial decision, even in spite of the rate increases that have been actuarially justified. Okay. I do want to just also address a couple other points that came up during some of the discussions. Genworth has not paid a dividend to its stockholders in at least 10 years. Genworth has been a company facing significant trouble for quite a while, so we suspended all dividends to shareholders, again, at least 10 years ago. As we mentioned, we expect no dividends to come out of our U.S. Life Insurance Company moving forward, and that's why we tell our stockholders that it's, from their perspective, worth zero. We're managing it for the benefit of policyholders, not for them. Unfortunately, the problems of long-term care aren't focused only on Genworth. There's another carrier coming in tomorrow. There is one carrier that is, unfortunately, a large carrier that has already become insolvent, a company named Penn Treaty. There's another company that entered last week into a stage called rehabilitation, that's Senior Health Insurance of Pennsylvania. Again, these overall macro challenges that have affected the long-term care industry have affected everybody. Genworth, as the single largest carrier, is the most concentrated case, and that's why it's particularly acute for us. We are far bigger than any other carrier and very, very concentrated in long-term care. So we cannot continue to sustain unlimited losses of the long-term care business because it's our biggest business, right? We don't have other big businesses that can subsidize it. It needs to get to break even over time, otherwise it will not be self-sustaining. Okay. All right. Sorry. So with that, and again, as Lynn said, we would be very happy to speak with anyone, each and every one of you afterwards to address further questions if we did not address it during our presentation. I want to talk a little bit about the claims experience that has developed. Long-term care is unique, right? I joined this company 5.5 years ago. And what I learned about long-term care at that point was it was very different than most of the other insurance products in the market up till then. Most of the other insurance products either were very well established, like life insurance, had very predictable benefits and generally improving. So mortality rates have been getting better over the long history. So when insurance companies sold life insurance, one, they could predict at a very high degree of accuracy the number of deaths per year, but also it was improving. So things were moving in the industry's favor. The other type of insurance is, short-term insurance like health insurance or property and casualty insurance, so homeowners insurance, for example. Homeowners insurance is generally priced on a one-year basis. So every year, the insurer can look at what happened in that year. If they made a mistake, they can quickly correct it going forward. So the next year's premiums will adjust for the experience they're seeing, right? So they get a very quick feedback loop. You make a mistake, you learn something new, you can correct. So the market is very much self-correcting in terms of those shorter-term products. LTC is unique in that, again, it was largely sold as a new product. We didn't have, as an industry here, we did not have experience on this product. We used other products that we thought were relatively similar, like disability income, to gain some insight. We looked at overall population rates of nursing home care, things like that. But it was a lot of educated, very informed, but at the end of the day, an educated guess on the future. Unfortunately, it took many years after the industry started selling the product before they realized all the mistakes they had made. And by that point, the industry was significantly upside down. So that's why the rate increases are so high, because again, we don't have the option of going back in time and saying, you know, we need to go back in time and raise the premium by 30% at issue. Unfortunately, the last 15, 20 years are gone. We can't go back in time and get those premium increases. We have to do it with what's left of the premiums to come in. We lost all those past premiums. We lost all the interest on those past premiums. So that really explains, again, the need for these really just admittedly shockingly large premium increases as a percentage basis, is because, again, you have to think about the long history of the product. There was another comment about, you know, comparing it to new business rates. I do think that new business rate comparison, if I'm thinking of the calculation that Mr. Dillon was referring to, it's an actually odd calculation. The calculation in general assumes that you're comparing the premium rates for somebody now based on the product that or the age at which they were issued. So you would compare if you're 72 now, but you bought the policy at 60, the age comparison is, well, how much is that 72-year-old paying now versus if a new 60-year-old bought a policy now? It's not an apples to apples comparison, and I've never understood why it was in some of the actuarial regulations. It is not, again, it does not make financial sense. Of course, someone buying the policy 12 years earlier will pay a substantially lower premium than someone buying the policy at 72. Okay, with that, again, I'm sure we've missed a couple of the questions that were asked, and we'd be happy to answer them afterwards. Just a little bit more on the actual claims experience that as it's come in. It did emerge slowly at first and has now emerged much more significantly over the last several years. Since 2010, the number of claims we have processed at Genworth has gone from 140,000 to almost 300,000. So it's more than doubled in just the last 10 years. And you can see back in 2005, it was only 76,000, so we're 4 times the number of claims we had in 2005. So we do have a lot more information now than we did in the past. We are monitoring experience as it comes in. Unfortunately, the last several years since I've been at Genworth, the industry experience has continued to get worse. So it would be great if I could tell you that we now know every mistake we've made in the original pricing relative to the future and we'll never need a rate increase after this one. Unfortunately, that has not been the case. Unfortunately, in general, for the industry, things have continued to get worse. That's why additional premium increases have continued to be necessary. In the case of the stable premium option we're offering on our newer product, again, at the time we made the filing, we didn't know of any additional premium increases, but we knew they were possible. So we were trying to give the consumer an option that would say, here's a product that will guarantee you a set level of premiums for a certain number of years in the future, because we don't know the future yet. And unfortunately, you know, as we talked about this morning, actually, in our earnings call, what we have found is, again, for that particular block of business, things have gotten worse. We will need more rate increases than what we originally expected. Okay. Now to go to slide 5. This is and again, I'm sure that Mr. Dillon was looking at the filing, so I don't know if if this is a difference in the timing of when when we did the comparison between what the cumulative premium increases that have been implemented in South Carolina versus cumulative premium increases nationwide on an average. I can tell you these are the rates as of the year, as of 12/31/2019. And states do move back and forth. You know, as one state approves, they'll move up for a while, then other states will move up. So depending on when you look at it, any one state will be a little bit ahead, a little bit behind. We do try our best to keep every state as close to a nationwide average as possible to prevent, any subsidization from state to state. Again, this is the cumulative rate increases across the country as of today. So, for example, if we look at PCS2, nationwide, we've increased premiums on average 230% for people who have unlimited or lifetime benefits, 193% for people who have limited benefits. In South Carolina, the comparable number is 172%. So you can see that while the South Carolina rate increases are certainly substantial, they are lower on average for that block. There are a couple of points on this grid that you will see what South Carolina is a little bit higher. Pre-PCS is at 105 for products that have non-lifetime coverage versus 96 for nationwide. Choice 1 is, again, non-lifetime at 107 versus nationwide at 96. These numbers do change continuously. We are continuously filing rate actions, achieving rate actions across the country, so that nationwide average is always going up. So again, and in general, again, one state will move ahead, and then as other states catch up, it will fall back again. So that is to understand. Another important point to address is how we're managing the block. We look at the portfolio in general and say, these older blocks of business, pre-PCS or Choice 1, which generated the majority of that $3.6 billion loss that we talked about, with the rate, with the level of losses we've seen at those blocks, we are just trying to get them closer to break even. They will never make a profit for Genworth. We are just trying to limit the losses moving forward. Based on that strategy, we have to make profits on our newer products because you can't lose money on everything, right? You cannot have all your products either losing money or break even. Some portion of your portfolio has to make money. In all cases, we are limiting our rate increases to what's actually justified, to what is allowed by the regulations. But the simple fact is we have to have enough money in the reserve or in the general account to pay the claims, and in order to do so, we cannot lose money on every block. Sorry, this is a lot of numbers, but I will just, point to a couple things, and some of it is somewhat redundant to Mr. Dillon's presentation earlier. But you have across the top the 6 product series that we're filing rate increases on. The number of policy. This is the policy form, which is if you have a long-term care policy, or really any insurance policy, in the bottom right-hand corner, there will be a form number which allows insurance departments and companies to know exactly what contract you received. The number of South Carolina policyholders, or lives, I should say, is listed next. You can see Choice 2 is the largest block, followed by Choice 1. The average rate increase requested, and that, again, for the most part, we have varied our rate increase requests between those with unlimited or lifetime benefits and those with non-lifetime. This is a blend of the two shown on this grid. The annual premium increase, if those premium increase are, the annual change in Genworth's premium, if those premium increases are approved. And then the date of the filings, which again was September 2018 for some of the filings, much more recent for group, November 2019. So these are the South Carolina department, other departments across the country do, take reviewing these filings very seriously. It is by no means a rubber stamp. We have a lot of back and forth interaction. They do consult with external actuarial firms often to do the reviews. To look at the lifetime loss ratios is I think, very insightful. The way we've defined lifetime loss ratio here is, think about it as, if you go back to knowing what we know now, go back to the time the policy was sold. Present value, all the cash flows back to the time. So take all the claims you're ever going to take, all the claims you're ever going to pay, discount them back to time 0 with interest, and then do the same thing with all the premiums you're ever going to collect. So for this ratio, again, the only things we're looking at are actual benefit payments paid to consumers, actual premiums paid by consumers. And at the moment, you'll see that, and the way we've broken this out is, on the one side of the slash mark is what the loss ratio is before the rate increase, the projected loss ratio is before the rate increase. And the other one is what it is after the projected rate increase. So for pre-PCS, we'll pay out roughly 5%. Without the rate increase, we're projected to pay out roughly 5% more in claims than we collect in premiums. For PCS 1, it's 40%. For PCS 2, it's 21.5. Choice 1, it's almost even. The newer products, Choice 2, it's 72.5. And the group product, again, is about 120. This is just claims and premiums. It makes no allowance whatsoever for the expense of running the company, for the expense of paying a distributor to market and distribute and deliver the company, to pay something like premium taxes. None of that is considered. This is literally just like a utopian world where all we had to do is collect a premium and pay it out in claims. Actual expenses, of course, would add probably 10 or 15% on top of this. So this is not sustainable. We cannot continue to pay out more in claims than we take in premiums. We will simply run out of money. And that's not a hypothetical. Again, it's happened in the real world with Penn Treaty. It is, there's another company in grave danger in Senior Health Insurance Company of Pennsylvania. Okay. This is a history of the past rate increases. As many of the other speakers came up and mentioned, most of the rate increases in the past have been in the 20% range. That has been, many of those rate increases were less than what Genworth requested. That's where they were capped at. So basically, for the most part, the rate increases after 2010 the requests were for more than 20%. That based on the disposition with the department, they were. The actual approval was 20%. Okay. Sorry, just before I'll go, and then I'll turn it back to Lynn. Again, I want to just personally say how committed we as a team are to trying to do the right thing here and trying to protect our ability to pay claims in the future. While again, I'm a technical person, I'm an actuary by background, and I'm focused on the financials. I'm also, a human. I'm also a grandson of someone who's in a facility right now. So I understand who has long-term care. I've seen that same experience when someone does not have long-term care. I can personally attest to the value of that product, to how much it releases or removes the stress on a family and what is inherently an incredibly stressful and emotional situation. So I do see the value, and I do, again, just ask all of you to think about the amount of premiums you will pay, either have paid or will pay, relative to the benefits that are available to you. And I also want to stress to you that at no point should you consider this we are being priced out of the market. We are incredibly clear that we want to work with you to adjust. If the premiums are something you cannot pay, we will work with you to adjust your benefits to find the premiums that you can pay. And in every case, if you're just completely fed up with the product, if you're doing it in relation to a premium increase, we will give you a paid up benefit. So you have a benefit pool equal to the cumulative amount of premiums you've paid, less benefits already received. So there's not a situation where we're trying to price people out of the market and have people walk away with anything. With nothing, I should say. We want to work with you. We want to find the best situation to the best solution to what is a very difficult situation. I think Lynn will go into that significantly more detail.
And before she comes, I've got just a couple questions.
Sure.
And here again, I'm going to caution you about that cord. I'm probably more nervous. Y'all can't see his feet on the table up in the cord here, and that's the last thing we need. I appreciate you addressing that's not you. I appreciate you addressing some of the concerns that we got. I'm still not so sure I've got my head around the fact that the requested rate increases would result in premiums that's higher than you're charging somebody who's coming in. But we'll study that another day. And you've indicated what other states are doing, and it's a concern of every regulator in this country that what my state is not allowing higher rates than another state. I mean, there's three buckets that regulators do or approve. Some will grant the total rate increases or a large portion of it. Some will grant something in between, and some grant none at all. It's the fear of every regulator. Is my state subsidizing another state?
Yep.
Can you address that?
Absolutely. And again, this is something that we are passionate about. Our CEO is extremely focused on combating, is to ensure that, again, there is equity across the states. We have seen some good movement over the last several years where more states are understanding just the critical actuarial need for these rate increases. So we have seen some of the states who had historically lagged catch up. We do think that there's really only it's really down to one state that has approved very little at this point. We have litigated with them up to their Supreme Court. We are in a Supreme Court appeal with them right now. So, but for the most part, we have seen good progress across the country. Again, something we remain very focused on and trying to keep everybody relatively balanced at the same premium levels. So.
Okay, and you've heard testimony from our citizens, and they do feel like they're being priced out and on the marketplace, and I appreciate you addressing the options. There are options that have come on in the last few years that you've outlined, and probably some more. But our folks are tightening our belts to pay your premiums. The obvious question is, what is Genworth doing to tighten its belt to make sure that the company stays in business with or without all these premium increases?
Sure, it's an excellent question. I mean, the first thing we have done is, Genworth is in a unique position against the largest long-term care insurer. Given the size of the product and given, again, while we have other blocks of business in the same company, life insurance, annuities, and those products are helpful in terms of providing some profits to subsidize the long-term care business, they're not big enough to subsidize it on their own. We have decided, again, that we have just committed the entire life insurance company surplus to the benefit of consumers. So while this was a public company, a stock company, right, it was for shareholders invested in it expecting return, we have now said, you're not getting anything out of this company, right? It's a zero. So in addition to the losses we have borne to date, again, the full $2+ billion of surplus is now fully committed to policyholders. We're focused on managing the company as much as we can for those benefit. We are doing other things to try to make sure we are as effective as we can be at claims management. We want to, pay each claim that is each legitimate claim with empathy and with compassion. But we do also, want to be diligent to make sure we're not being subject to fraud and abuse. So we have increased our efforts in those areas. So.
Okay, thank you, Mr. Chair.
So you heard, I think the director and Matt and Ms. Franklin talked a bit about options available to policyholders. And let me start by saying that this is an area where we feel like we have a little bit more control over how we treat you, how we interact with you, how we give you information. So we're trying to do the very best we can in this area. And we have a number of different resources available to help you as you consider these options. But one of the things that you can do, of course, is you can keep your current coverage and pay the full amount of the rate increase. And we find that most of our policyholders are doing that. They understand the leverage that the product affords. They understand the level of benefits that they purchased, and they are paying the full amount of the premium. But there are others who are adjusting coverage, as Ms. Marshall pointed out, and there are several different ways, different policy features that we can adjust to help you pay a premium that is that you're comfortable with. And these are choices that individuals need to make with some guidance to do what's best for themselves and their families. And we try to ensure that we are there to help guide you through those processes. The third option that Matt alluded to was the optional limited benefit, where you say, I am not paying anything else at all. And to the extent that happens, and even assuming you pay no premium within 120 days from the time that we notify you that there's a rate action, we will assume you are electing this option, where you will receive a paid up policy equal to the amount of premiums you've paid minus any claims you've paid that will be available for your future use. Now, in addition to that basic schematic, you will find that Genworth, like some other carriers, have been really working very hard to come up with different options that we can make available to policyholders. We've been innovating and thinking and trying to figure out what else we can offer. And as a result, we did come up with some additional options available to policyholders, and they were rooted in a study done by PwC that said that 70% of most long-term care events, 75%, will cost $250,000 or less and have a duration or a length of time of about 3 years. So using that kind of as a benchmark, we developed what we're calling our stable premium option, and that is an option which will afford a 3-year benefit period. It allows you to retain any increased daily benefit resulting from a benefit increase option that you have, and then continue to grow at a 1% rate. And then there's an option that the policyholder would make about whether or not to extend an elimination period or to engage in or to have some coinsurance. And with that particular construct, there is a rate guarantee, and depending on what product that you have, it's either through 2028 or 2024. And usually these afford a benefit pool of about $270,000 to $275,000. In addition to that, we are offering in South Carolina a new option called the limited benefit with payment for partial policy disposition. That's a whole lot. But basically what that does is combine a limited paid up option with a cashback payment or a cash payment. And that is a new option. I believe one of the policyholders who wrote in took advantage of that particular option. So there is still a limited, a partial limited paid up policy in addition to cash payment. And those are available for most of the products for which we are seeking rate increases in South Carolina. Now, what we try to do is ensure that you have all of the information that you need to make an informed choice. And that starts with the written communications that you receive. So when there is a notice of a rate increase, Genworth will also send with it a letter that outlines some basic options that are available to you. They are not all the options that are available to you, but they are basic options. And that one will show you paying the full amount of your premium. Then there are a couple of options if you decide to reduce benefits, and then also an option if you decide to pay nothing more. And we make very clear that you can always call us. We encourage you to call us so that we can talk through other options that are available to you as well. Now, the letters that we send out have been designed and tested through consumer groups because we were trying to make sure that they were as easy to understand as we could make them. We are continuously working to improve this process so that it is the information is accessible to you and easy for you to have. You will also find in the notifications that we send a summary of the local cost of care in your area so you can make some comparisons about what you're choosing versus what the potential cost may be for care. In addition to the letters, Genworth does have a website that is devoted to LTC premium rate increases, explains some information about why the increases are needed and your options in addition to the value of long-term care coverage. And we will note too that our Chief Executive Officer, Tom McInerney, as a result of conversations with policyholders, is launching a newsletter that will also provide additional information that you will see soon online. And we have piloted that process in a couple of states thus far, and Tom also sends regular updates that he authors so that people have some sense of the current status of the rate action process. You can also view and elect coverage options online through this website. Now, I spoke to you about the people available to speak with you. They are specially trained. We have a team of 60 people that only speak to policyholders under these circumstances. They've assisted almost 270,000 policyholders and agents in the last 2 years alone. And Matt and Warren and I, as well as our CEO, has actually sat with members of this team to hear calls and to understand how those conversations unfold. And we're committed to ensuring that the very best resources that we have are available to assist you in that regard. Now, finally, just in summary, we wanted to emphasize that we're seeking these rate increases to ensure that we are able to pay future claims. And I think that Matt explained very clearly that we are not using the funds available in this entity for anything else other than the payment of future claims. And we've absorbed substantial losses. We know this has been painful to you. We have shared in that pain because we do not want people to think that we have passed on to policyholders the cost of the scenarios that we've been encountering. We really do try to act in a reasonable and responsible way. And it is difficult, we know, and we are grappling with these decisions and these issues every day. It is not easy for anybody, so we're trying to ensure that what we're doing is balanced and it considers the interest of all stakeholders. And certainly we want you to know that there are a variety of options available to mitigate your rate increases. So know this above all, that we never lose sight of you and what we're doing. And while we're not always doing things that you're going to be pleased with, we are trying to do the best we can to manage through this process in a way that will ensure that your claims are paid if you need them. Thank you so very much for your time. We hope that we are giving you information here, and we'll give you information when you face issues that will help you make informed choices that are best for you and your family. We are certainly willing to take questions.
Good.
Yes.
I thought you would.
Yes. Do you want me to stay or shall I go back?
You can stay
All
right
right.
there for a second.
All righty, surely.
We certainly appreciate y'all being here. This has been instructive and informative to us as a department and to our citizens as well. What concerns me, you've outlined how many rate increases you've gotten over the last several years, been on the chart Mr. Kepler had. The takeaway for us is this isn't over. That, if we grant whatever we grant, you're gonna be back at least on 5 out of 6 of those lots that you've got. That's not a lot of comfort for us. It's not a lot of comfort for you in your situation that you're trying to make sure the company is around to pay out the claims that you're incurring. So that's a concern of ours, it's a concern of everybody else in this room. But we appreciate you addressing that. We appreciate you addressing the options that people have. And quite honestly, when we got here 7 years ago, those options didn't exist. It's from the efforts of the folks in this room, from the department, and with the cooperation of the companies and other regulators throughout the country that we've come up with this number of options that are available. Becky Dover, do you have, as our other consumer advocate, do you have any questions that you would like to ask? You can summarize them or.
Yeah, just a couple. You mentioned that you send, with the notice to consumers about the rate increase, you send them some of the options.
Yes.
Are the options that you include with that the ones you just showed us on that slide?
It will vary by policyholder. It's very individual. It's driven by an actual algorithm that understands what the benefits the policyholder currently has, and then there are options that are chosen to show different rate levels. So, but those are not the only options available, and that's what we try to be clear about. It's just an example of options that the policyholder could consider.
And then I guess those disclosures to consumers about the request for a rate increase, I'm assuming you're including in there how long they have to make a decision if they want to execute one of those options?
Yes, absolutely. And we try to include the time. The timing is listed in a sheet that gives several pieces of information about the premium rate increase. And the date even is referenced in some specific parts of the letter. So it'll tell you a number of days and the date by which we would need to hear from you. And once again, if you stop paying premium within 120 days of the time that premium is due, we assume that you want the optional limited benefit.
That's all I have.
Okay, we have time for a couple of questions from our citizens that have made the trip here and have bravely listened through over 3 hours worth of testimony and conversation. Yes.
Thank you. I want to know what y'all as a company are discussing with our representatives in Washington about bringing down healthcare costs.
So as part of my job as chief of staff, I'm also the head of government relations for Genworth. And so we have been engaged, particularly with the Treasury Department, the Federal Insurance Office, on some discussions related to long-term care. I think that group is very much interested in working with the National Association of Insurance Commissioners, who has recently developed a task force that now includes 44 states that actively is looking to address issues connected to long-term care. And so there is some desire to ensure that state regulators have an opportunity to engage on this, and I know that Director Farmer in South Carolina are engaged there as well. But we are looking on the federal front to speak specifically to issues that would help ensure that long-term care is available going forward, because it definitely affects Medicaid and Medicare, and because of the demographics of the population, we know that it is critically important that this coverage be available. So we're trying to ensure that federal regulators and legislators have information connected to that. And Matt, did you have something else?
Beyond long-term care.
Yes.
If the cost of medical care starts to go down and people can access good medical care when they're 50, they're not going to need you.
Yes.
When they're 80.
Mm-hmm.
It's all packaged into a big thing. And
Yeah.
we've got to do something about bringing down the cost of medical care. And y'all have a voice. I don't have a voice.
So,
You got a voice.
So let me say two things there. That yes, information about an encouragement of healthy lifestyles is critically important, and we have engaged in an informational campaign on both the federal and state level. And Genworth too, individually, we're looking at our policyholders and thinking, are there programs that we can offer, or information that we can offer that might keep people healthy longer? And we are also considering whether or not there are services that we can offer that will enable people to stay healthy longer. I was at a conference a while ago, and there was the notion of a sensor that could be put between a mattress and could gauge sleep patterns that was predictive of when somebody might even fall. And those types of devices and things would be very, very helpful in this front. And there's so much work to do on that front, and we appreciate that charge. We're trying to do it as a company, but we're also trying to influence policymakers to ensure that information is available. And when we talk about the need for long-term care and the need to plan for it, included in that, subsumed in that, is the need to ensure people understand the importance of maintaining a healthy lifestyle.
Mr. Robinson.
My question is so technical that I'm not going to keep everybody here to hear the answer. I'm going to just ask them directly after.
Okay.
Any other questions? Thank you, Ms. White.
Oh, no problem. Thank you, Director.
So we're gonna be careful. So we're gonna wrap this up. A couple of things. To your question on Ms. Siegel on federal issues, national issues, Ms. White was correct when she said the National Association of Insurance Commissioners has developed an executive level task force. That means only commissioners, my level, can sit on this task force. There's over 40 We have 56 jurisdictions, the 50 states, DC, and the 5 territories in this association. This is the #1 issue, not only for me in South Carolina as the regulator, but across the country. We've got to get a handle on this. We may be one of the few states that are having these hearings, but every regulator in my position it is concerned. We are extremely involved in not only that task force, but at the national level of National Association of Insurance Commissioners. It just so happens, as luck would have it, this year I'm the president of that organization, and this is my day job, and I appreciate that. On the federal level, we've made that same request of our federal government. 2017 or 18, I testified in front of Congress in front of the Senate committee, looking at Affordable Care Act and all things health care. And at some point, we've got to get a handle on what insurance pays for, whether it's long-term care or whether it's everyday medicine, in our normal lives. When I talk to our citizens and having these conversations, I find out what they're paying, what they're going to be paying a month, what they're going to be paying a year, and I beg them, before you make a decision on what you do on your long-term care coverage, make an informed economic decision. Call that nursing home down the street, call the assisted living, call the people that come in, that help Mr. Barrett and others, and find out what that's going to cost a year. We're paying extremely high premiums for our long-term care coverage. It's still a bargain. I've only, out of all the citizens I've talked to, there's only been one individual that I was comfortable when he said, I'm going to drop my coverage. He was in an economic situation where he could, and I wasn't worried about him. The rest of us, I would worry about. So I've cautioned and I've urged all of our citizens to do that very same thing. The options now are there. We have some options that we didn't have 7 years ago. They're not good options, trust me. When we bought this stuff, it's just like you buy your auto insurance, that's for a set term. We kind of thought this was for a set term. It's not, obviously. So we've got to work as a regulator, as citizens, and the company to come up with solutions, and they're not good options right now. The hearing part of today is about to be concluded. For those citizens that are here, the Department of if you look on the back row back here is our consumer folks. If you have the first question, any question, they're here to answer those. They're here to talk with you and the company. The company has agreed to hang around a little bit longer. Those conversations in the past have been fruitful. So I would encourage those of you that are left and have questions, please avail yourself to that opportunity. With nothing further, I'm looking around the room at staff and others. Say it again? Okay, for our citizens that are left, we can't provide much, but we can pay for your parking before you leave. so.
If you have one of these, just make sure you go to the attendant, not to the automated machine, because
Right.
It's not working with the machine.
The attendant is the one on the farthest right as you go out of the 3 gates that you go out. So with that, I want to thank you again for coming. I think this has been productive. It's been informative and instructive. And that concludes the hearing. You'll have a nice rest of your day.